Welcome to The Peel. I'm your host, Turner Novak, founder of Banana Capital. Today's guest is Zaid Rahman, co-founder and CEO of Flex, the AI-native private bank for high-net-worth middle-market business owners, headlined by a 60-day interest-free credit card for businesses. Flex is fresh off a $60 million fundraise and just announced their new consumer product, Flex Elite, which pits it head-to-head against Amex for the consumer spending of some of the wealthiest people in America. Flex is the private bank Silicon Valley forgot to build, going after customers that Flex thinks it can be the category leader for. This 2.5-hour conversation goes about as deep as you can get on everything Zaid has learned building the AI private bank for business owners. We talk about why no one has built it before and how AI recently unlocked this opportunity to serve customers that power 40% of all US payroll. We also unpack why VCs traditionally hate investing in lending businesses, how AI makes private credit a sexy asset class, how Zaid and Flex survived the post-ZIRP fintech winter and raised a Series A in 2023, the power of being both easy to onboard and multi-product as a fintech company, and Flex's go-to-market playbook that acquires 85% of all new customers through organic channels like word of mouth and referrals. A quick thank you to Eric Bahn at Hustle Fund, JMJ at Chapter 1, Andrew Ziperski at General Catalyst, and Jared Thomas and Ewan at Flex for helping brainstorm topics for Zaid. A reminder, I publish 2 episodes of The Peel every week. Check out the back catalog of over 100 episodes exploring the world's greatest startup stories, like last week's with 8 Sleep co-founder and CEO, Matteo Franceschetti. Now, let's talk to Zaid. Zaid, welcome to the show.
Thanks for having me.
I'm excited. You announced something, I think today, the day this comes out, you have announced something. What did you guys just announce?
Yeah, no, very excited to announce today that we just closed our $60 million Series B, led by Portage Ventures. Portage is a very large fintech dedicated fund. So they led this round and had a bunch of our existing investors and new investors join it.
Amazing. And what do you do again? For people who don't know, I know, but yeah. I actually forget sometimes because you guys have been adding a lot of different features over the years.
Yeah. No, it's a great question. So just taking a step back, right? This is my 3rd company. I've been building companies for a while. And building these companies over time, you realize the most sort of common frustration you'll hear from all founders and business owners is that running a business is really, really hard. And the thing that really sucks the most is finance, right?
What's so hard about finance?
I mean, if you think about it, it's not just, having a bank account and counting your money. There's so much stuff that needs to happen in the back office across, managing your working capital, money coming in, money going out, thinking about payroll, your benefits, your insurance, your working capital, thinking about accounting and tax and financial planning. And then if you're a traditional business owner, not everyone's venture backed, right?
Yep.
The challenge with that sort of situation is you're sort of intermingling your personal and business finances often together, which is a whole new challenge that sort of adds to this mix.
Which you guys just launched that today, right? Was the new kind of, So what did you launch?
So we just launched Flex Elite, which is our sort of newest platform as part of the Flex ecosystem, where now we have both business and personal products in one. And so, just taking a step back, right? If you're a business owner, you don't want to be juggling 20 different products. You just want to use one consolidated ecosystem to manage everything in one place. And so with Flex, we realized that there's a huge opportunity to build a singular platform that tracks every single dollar in a business owner's life from the time they make a single dollar of revenue to the time they spend it personally on their lifestyle. That journey, revenue to lifestyle spend, is like 25 chapters. And each chapter, we think there's an opportunity for a new financial product, new agentic kind of automation, new sort of software to sort of help you sort of manage your life better. And it starts with, all the way from credit to business finance to personal finance to managing all the payments happening in your back office, and all the way down to sort of an ERP that helps your back office do more things.
Doesn't this kind of already exist? Like if I use Chase or like Bank of America, like they have thousands of branches around the country, multiple in every neighborhood, basically. Like, can't people just use those?
So if you think about it, like B2B fintech, first off, like just, zooming out and thinking about the B2B fintech market at large, it's sort of a spectrum, right? On one end of the spectrum, you have these sort of micro businesses. These are like your 1 or 2 person companies. Technically, an Uber driver or DoorDash driver is a micro business owner, right?
Yep.
And that's what the big banks really focus on because they're effectively consumer accounts, right? Your Chase, your Capital One, Citi, et cetera, really, really focused on this sort of micro business owner.
Why do they focus there?
Because, it's easy to underwrite. They're sort of cookie cutter. You can just, almost use a consumer-like model.
Just like what's your credit score? Like 720, you're good.
Yeah, exactly. That type of thing, right? And there are quite a few of them, right? There are tens of millions of these micro business owners. On the complete other end of the spectrum, you have sophisticated enterprises. These are folks that have CFO, head of FP&A, right?
So this is like a company like Google or Walmart or something who have like tens of thousands.
On the complete high end, it could be something like a Walmart or Google that is a Fortune 500 business. But it could also be, a 500-person company that is super late stage, venture-backed, private equity-backed company, all the way to, public companies that have auditors and FP&A and CFOs and, outside sort of tax consultants and those types of things.
Yeah.
The types of problems that those companies are solving is very, very different from the micro business owner, right? And so that's what, some of our peers in fintech like Ramp, Brex, Navan, SAP Concur, all of those folks have built incredible workflows for those types of teams that have thousands and thousands of employees. The sort of common adage you hear from some of our peers is that, they help, these companies save money. Well, who cares about saving money? It's large enterprises.
That's
right.
fair, yeah. They're all cutting costs right now.
But there is a business owner that's neither a micro business or a large business. It's sort of right in the middle. The phrase we use for these types of business owners internally is jumbo shrimps.
Jumbo shrimps? I actually love jumbo shrimp, by the way. Like a big shrimp cocktail.
Yeah, exactly. They're delicious. And the thing about, these types of business owners is that, their revenue profile, just to kind of give you a picture, can be anywhere between, let's say, $3 million on the low end, can be a $100 million business on the high end. But typically it's owner operated, where the owner who started it is still operating it. They own it outright. And they're probably, EBITDA positive, where they're doing, on the low end, a couple $1 million in EBITDA. On the high end could be doing, say, 20 million in EBITDA, right? The reality is that if you're the type of business owner that, first off, owns your business, and secondly, is generating millions of dollars a year in profit, you live a pretty fucking good lifestyle. Excuse my language, right? And so these types of people are the types of people who have, let's say, an Amex Black Card, right?
Yep.
They're the types of people who typically have a relationship with a small regional bank, right? There are not that many of these people out there. It's maybe a few 100,000 business owners, on the high end, maybe 500,000 business owners. What's really awesome about these 500,000 business owners is that they touch 40% of American payroll.
Really?
So they're basically the lifeblood of the American economy.
How do you get that stat? Like that, is that just something you pulled out of a McKinsey report, or how did you get that number?
No, if you just look at the number of people employed by mid-market businesses and multiply that by the amount of, U.S. payroll reported by the U.S. Census, it's a fairly substantial number, right?
Yeah, I guess if you say 500K, you assume they each have 50 employees. I don't know. What does that get you to? Like, not good at math. Gets you to like 25 million people.
25 million people.
How many people work in the U.S.? Maybe like 100 million. So maybe they each employ like on average like 100 million people. That probably gets you higher.
Yeah, no, but if you think about, there's some mid-market companies that, have hundreds of employees, and there's some that have 10 employees, right? So you average that out. And then a lot of them, touch 1099s, right? Because they employ contractors. And then they also sort of, do business with other sort of micro businesses. And so if you kind of think about, the money flowing from these businesses, it's a very large amount of dollars. And yet, no one quite focuses on this mid-market business owner, right?
Why not? If it's so big, shouldn't there be a bunch of people trying to build products for them?
Fantastic question. This is a thing that has puzzled me for a long time. So what's interesting is, a lot of our fintech peers, they focus on the upmarket opportunity, right? They're going after very large logos. They're going after the NVIDIAs and Apples of the world.
Are they more profitable because they're bigger?
No, it's just they're sort of building, piecemeal kind of solutions that are intended for very large kind of businesses where you won't hear an NVIDIA adopt a single platform for 20 different workflows. It typically will be the best in class in each workflow because they have the sort of HR sophistication to then go and sort of find the right kind of people for the right tools, right? Whereas our mid-market business owner, right, they don't have the time or energy to sort of put together a finance stack that, is best in class in every single category.
They might have like one or two finance people and they just do my accounting and my taxes, just do it all.
Right. No, exactly. Right. So they're using stuff like, there's some person in the back office, right, who's sort of like their catch-all accountant. And they're typically using, some tool from the 1990s and or Excel or just keeping a lot of the stuff in their head. So going back to your question of why no one serves the mid-market, what's funny is that they're actually, there's a regulatory reason. A lot of banks after 2008 were basically not allowed to lend to mid-market businesses.
Why not? They sound like interesting customers to go
right?
after.
It's super counterintuitive. Well, banks have, a lot of reserve requirements on how much capital they have to keep on balance sheet, depending on the loans they make as sort of loan loss provisions. And so after Basel III that was passed in 2008, the way the sort of regulation was structured, the regulation preferred commercial real estate and sort of consumer lending and sort of made it much harder for SMBs. And so this created this kind of world of private credit. And so you hear a lot of big firms and you hear even firms like, massive asset managers like Apollo and KKR and Blue Owl. And they're effectively lending to middle market businesses, but they're going after the larger middle market companies that
They do a lot of like a PE buyout. They'll work.
Exactly.
If you think about it from a customer relationship, their customers really like the PE firm who owns a bunch of smaller businesses underneath.
Yeah, exactly. Right. So they're going after their check sizes are in the $50 to $500 million range. Right.
Yep.
But what about, the logistics company that's making $50 million a year, 5 million EBITDA, owned by one family, really good, living the American dream.
Yeah.
Who is helping that, business owner and their needs? Turns out, we don't really have, anyone in our space, at least, directly competing with us with this sort of proposition that we want to manage everything in their life from the time they make a single dollar of revenue to the time they spend it personally in their lifestyle.
I mean, that's kind of the commercial bank, like the community commercial bank used to or is kind of still that. Or
what's interesting is that we often will come across regional private banks. And so a lot of times people refer to us as sort of like a fintech private bank or an AI native private bank, helping, these types of business owners that, are wealthy, right? They're employing dozens of people and, they're growing at a moderate, rate year over year and very stable. But yet, the only folks sort of helping them are these kind of, random regional banks that are sort of hyper local and don't have sort of the best technology stack. And, getting a loan from them, for example, takes months and months. And, it's sort of like built on incumbent sort of finance stack, right?
Yep.
So that's who these people typically deal with. And then, of course, the company that has, the largest kind of market share in terms of corporate card and even personal card is Amex, right? And so Amex, something like half of the business owners in America use Amex, right? Most of our customers are on the higher end of credit worthiness. And so 85% of our customers today come from Amex. Amex is an incredible company. They're really focused on, giving you incredible sort of rewards and travel experiences and those types of things.
Yep.
But the reality is that there are some business owners who just don't care about that. What they care about is making more money. And the way you make more money is, running a far more efficient business and getting the right type of private credit to really fuel their ambition. And so, our tagline at Flex is Flex fuels ambition. Some of our peers try to save you money. We try to make you more money. Right. And so that's sort of how we're differentiating ourselves.
So you're almost selling to the CEO versus selling to the CFO.
Our customer is the business owner.
Yeah.
You will never come across an ad that says, Flex is for finance teams,
Hmm.
right? Because we are really, really ultra focused on this forgotten segment of business owners, which is why we believe, going back to Flex Elite, which we launched today, which is our sort of, private banking stack for the business owner.
Yep.
Our vision is that if we serve the business owner well, not only in their business life, but in their personal life, we can maximize their wealth, right? And so that entails everything from, giving them credit cards and bank accounts like a private bank, but also giving them software to manage their family spend like a business. So, we've built family expense management where you can issue cards to your family members and issue cards to your, housekeeper and tell them that, hey, you can spend a couple $100 at Costco and that's the only merchant the card will work at and those types of things. You can also sort of track your net worth across your public and private assets, which really is helpful for these business owners to really kind of consolidate their entire financial life in a single motherboard, such that then they can go and, focus on running their business as opposed to sort of juggling a bunch of tools.
So you mentioned there's maybe hundreds of thousands of companies and people like this around America, these people who own like pretty profitable, small businesses. It's kind of like an offensive word because these aren't small businesses. These are like pretty healthy sized businesses doing 7 and 8 figures in cash flow. Like, who are they? Like, what kind of companies are these?
Yeah, no, it's a good question. The average customer we come across is, first off, interesting insight, less than 13% of our customers are in New York and California. So these tend to be, in middle America, right? The parts where your glamorous sort of like banking services and fintechs are not really focused on, right? They're running like really stable businesses and they tend to be in service industries like construction, logistics, trucking, even like, industries like farming and, they run or they run sort of a sort of digitally native business that they bootstrap. Like, they might be
like an ad agency or something.
Yeah, ad agency, or there might be a direct to consumer brand or, something like that. Right. And so the thing with these folks is that, they're not really being targeted. Right. And so they just go to whatever is sort of the most popular option, in that community. And so we have almost kind of, our go-to-market motion is like literally building almost like a regional bank, hyper-localized strategy where we go to these sort of markets left behind. So not New York City, not San Francisco, and really sort of target business owners in those sort of local markets and build a community around them and sort of create sort of opportunities for them to, meet other business owners like them, which is sort of like unusual for some of these owners, right? Because they're sort of like in their own kind of bubble, right?
Yeah. That's a very like New York or California type thing though, is to go meet other founders in San Francisco or another fintech founder in New York.
Yeah, exactly. Right. Like, and who knew, like, almost creating like a city by city distribution strategy is the way you would go acquire these customers. And who knew that, community events actually is the most successful sort of channel to acquire these customers.
Yeah. I remember one time you told me events have negative CAC or something like that. So you explain to me how that's even possible.
Yeah, no. So we do a lot of events. We actually do so many events that we actually decided to build our own events software.
Okay.
So when you sign up to RSVP for a Flex event, you're basically part of the Flex ecosystem, right? We think of you as, a customer from the point you first learn about Flex, which in this case, let's say is a community dinner we're organizing in Dallas or Nashville or a place like that, right? And what's interesting about that is, they'll come to our event. Let's say there are 20 people at the event. We typically will partner with a service provider to sort of co-host that event with. And often, these events are so successful that we have sort of an inbound list of people wanting to co-host it with us and almost sponsor these events. And so what ends up happening is that engine allows us to significantly reduce our event marketing spend. And often, some of our events are, fully break even, which is really interesting from a CAC dynamic standpoint.
Yeah.
We're sort of like very kind of unlike most fintechs I know, where we have a very contrarian approach where less than 15% of our total sales and marketing spend goes on to digital marketing.
Okay.
Almost our entire spend goes on, creating these communities and developing our referral strategies with our partner ecosystem. And so that's been really awesome, where you can't quite do that, at sort of a national level. You have to sort of create these hyper-targeted strategies that are localized to these communities.
So if I wanted to try something like that, like let's say dev tools, or maybe, I don't know, pick a category, doesn't matter. But if I wanted to try doing this, what would you recommend to kind of get started?
Yeah, no, it's a good question. Look, the reality is that there's a certain type of business owner that doesn't really care what your solution is.
What do you mean by that?
Right? Like if you're a venture capitalist, you're busy, you're meeting founders every day, you're
recording podcasts.
You're recording podcasts, right? And the reality is that, like, if I come and like pitch you, like, oh, like, I don't know, I'll just pick a random example, like a accounting service for venture capital firms.
I actually get that one. I get that more often than you would think.
Right? The reality is, like, the average business owner, including yourself, the default response is, why do I care?
Yep.
Right? Like, it's sort of true. And, maybe even if, like, honestly, your product or service is 10 times better than what exists, right? Even in that context, it's really hard to get the attention of the right ICP or right sort of ideal customer profile. And so what we realize is that, events and sort of, building communities around business owners, where business owners are excited to meet other people like them, is actually a much better avenue to get their attention.
So you're not even wasting time sending them cold emails. You're basically having their friends invite them to hang out at dinner or something like that.
Yeah, absolutely. I mean, we're doing an event next week in Miami. We've gotten hundreds and hundreds of sort of people coming to us. And, it's a lot of companies will stop at that, right? They don't know how to sort of translate that demand into sort of actionable customers. It also helps if your product is actually solving a problem, which in our case, our sort of speed to value when customers come into our ecosystem is really fast. And the way we do that is we embed sort of credit into their sort of transactions, which immediately provides value to your small business owner, right? But then, how do you build that sort of engine that knows how to sort of convert these, cold leads, if you will, into sort of, customers, and how you build a sort of life cycle around that so that they're adopting, your next product and product number 3, 4, and so on and so forth.
Yeah, how do you do that?
I mean, it's that's sort of the growth engine we've built at Flex. One fun stat is our average customer uses 4 or more products, right? Which is very, very high. I mean, we have publicly traded fintech companies where, after 10 years of being around and spending hundreds of millions on ads, they're only now getting to a point where they have 3 or 4 products being used by their average customer.
Yeah. I think you were like 2.5 less than a year ago, right?
Yeah, exactly. It's a combination of things, right? One, we've shipped a lot of products, right? We have this sort of 5-pillar strategy around private credit, where we give you short and long duration capital that's sort of elastic to your needs. Second is a sort of comprehensive business finance stack around banking and cards and expense management at the business level.
Yep.
Third is, the personal finance stack, which, manages your family transactions. Fourth is payments, so managing accounts receivable, so collecting funds from your customers. And then accounts payable, which is, optimizing vendor payments and those types of things. And then finally, we're building an ERP, which is sort of more nascent today, but, the idea is to basically be the end-to-end stack for that business owner. Now, the reality is that when a customer sort of enters this sort of journey, it is really important for a multi-product company like ours to build a right life cycle. And so we've spent a lot of time on growth engineering and sort of life cycle hacking to really sort of figure out how we can introduce Flex to the right customer at the right moment with the right product.
And so I'm assuming being so modular, like multi-product like that, like I might be an anti-debt person. Like I never have debt in my life, but I'm like, this invoicing thing seems better than what my bank has. Like I'll try it.
Right. We have customers today who start with an invoicing product, which we give away for free, relative to a lot of the invoicing solutions that will charge, 1% of every sort of ACH transaction and very high credit card acceptance fees. What ends up happening is that, that customer might start with invoicing and then they realize, oh, I have like a lot of AR built up, a lot of customers who haven't paid me and I need some float for 60 days. Well, we have this sort of 60-day product that does really, really well, where every single transaction on our business credit card gets 60 days. And then you can also use that to fund your bill payments to your vendors, right? And so that's an example of like how like a customer started with one part of our sort of ecosystem and over time, moved on to a bunch of other things.
Because you typically can't do bill pay on credit, right? Like you can only use ACH.
Yeah.
So if I wanted to use credit, I would have to have a credit card and I'd have to pay the credit card fee typically if I'm doing that. And you guys essentially help somebody get around that.
Most credit card companies like think in very sort of boxed ways. Like, hey, I'm a credit card and the use case is X and so on and so forth.
Yep.
We realized, the credit card limit is an abstraction, right? Like how it is used is sort of, dependent on the products that you have. And so rather than giving you a credit card limit, we give you an account level limit. And the way you use it is up to you. So you can use it through our cards. You can use it through our bill pay product. You can use it, for sort of future products that we're launching. And so what ends up happening is that, let's say you have a situation where you need to pay a vendor and the vendor does not accept credit cards, right? The way it would work today is you would basically have to send them a wire ACH, or you would have to use a third-party payment service that charges a very large transaction fee. What we can do on our end is, basically tap into your credit limit and process that transaction. We'll charge you a small fee for that, transaction fee for that, but it'll be much lower than the sort of card acceptance fee that a lot of these platforms charge.
And it's kind of related, I think, to how you first kind of started the company. You started in construction, and that's why I met you. I don't think you guys had launched yet. You were kind of like experimenting.
Yeah.
You're figuring out what can we do here. So why did you start with construction originally?
I'm Indian originally, but I grew up in Dubai. My family runs a medium-sized construction business in Dubai. And so
what kind of stuff do you guys build?
Just a bunch of very tall buildings in Dubai. So when you see those like aerial shots of Dubai,
your guys' name maybe on one of those?
Not quite big enough. I mean,
I guess medium size.
Medium size would be like what was a service provider on some of those bigger names, right? Okay. And so growing up, I would just hear my father complain about finance all the time, right? In an odd way, this is my third startup, and in prior companies, I sort of like was close to the sort of finance of those companies as well. I think that running a, medium-sized construction business is actually a lot harder than running a venture-backed startup.
Really?
Right. Because
what's so hard about it?
First off, you're real goods. You're dealing with inventory.
To actually build a physical thing.
You have to like build like a wall, and you have to like get the right materials on time, and you have to sort of manage kind of working capital, and then you have a lot of like subcontractors, and each subcontractor has its own kind of billing practice, and there's a lot of trade credit flowing around.
So it's basically like it's sort of like some like those open AI deals where it's like I will pay you $1 million when the deal is done, when the building is done in 2 years.
I cannot tell you how great of an analogy that is. There's so much circular trade credit type stuff happening at these businesses that you can sort of like, you can think of like, a single transaction having, 10 different parties involved. And so in many ways, today's systems are just like not designed for that type of customer, right? But the problem is that business owner is still not the most sort of tech savvy customer, right? They often are, sort of a construction person, as an example, that started that business and, now building a pretty large business, but they still haven't sort of built out the tooling they need to sort of be an enterprise level business. And so how do you build enterprise level workflows in a consumer like user experience, right? Which is a real kind of challenge. And so I started in the construction space initially with this company, Flex. And the idea was we'd build like, an end-to-end sort of fintech for construction businesses. But what's really interesting is the problems that we solve in construction businesses oftentimes would be problems that, other types of companies have as well. One problem was, we get paid late. Yeah, construction companies on average get paid 60 days late. And so we launched this 60-day credit card where you get 60 days on every single transaction. And if you pay us early, we give you points and cash back. Really successful, right? Like you literally have a gamification mechanism where you can drag a slider and, if you want flow.
Oh, yeah, I've seen that.
Yeah.
I never do it. I just pay it. I pay the latest I possibly can.
Yeah. Yeah, exactly. But, you have customers who want that flexibility. Some are optimizing for rewards and some are optimizing for just cash conversion cycles, right?
Yep.
But it turns out this Net 60 program was so successful with construction businesses, they started telling their friends about it. And when we started running ads, we started seeing, non-construction businesses coming to us. And at one point, we had so many non-construction businesses coming to us that 60% of our leads, about 2/3, was literally non-construction businesses. And so at some point, we realized that while we're shooting ourselves in the foot, we should probably, expand our horizon. And so we went horizontal from there. And now we are the sort of end-to-end sort of fintech platform, almost like a private bank for middle market business owners.
And so that very first product was essentially like a credit card.
Yeah.
Is that kind of how you market? Like a credit card for was it like a subcontractor most likely, or was it like a general contractor? Yeah,
subcontractors or like smaller general contractors, right? They're in the sort of 50 to 100 million revenue range.
So why'd you do a credit card specifically? Because you could have solved it other ways.
What's funny is that we actually first started with a accounts receivable, accounts payable solution for these types of businesses. And venture capitalists, by the way, love that product. For some reason, they think, payment workflows, that's where we need to put money, especially if it's a verticalized payment workflow.
Yeah, for construction, which is a massive TAM. And it's like,
oh my goodness.
It's like 10% of global GDP or something.
Yeah, they're like,
big number.
Wow, big numbers, payment workflows, except that is a vitamin. You know what people really care about? Money in their pocket today, right? And so we quickly realized that the painkiller was actually working capital. And, the challenge for these business owners is that navigating credit is really, really complex. It's almost like a lot of companies in fintech, avoid, going into the credit space. It's almost like a aversion they have to understanding how working capital works. But big banks have done it for decades and decades, and they're very successful.
I mean, isn't there just a massive graveyard of failed kind of SMB lenders in San Francisco? Like, I feel like and we could probably spend the rest of this podcast just going through all the people that have died trying to do this. Companies, not people. The companies that have died.
Yeah, I mean, there's a lot to sort of unpack with that, right? So first off, business lending is a very broad spectrum, right? If you're lending to a small business owner who's technically an Uber driver, is very, very different than if you're lending to, let's say, Blue Owl just did a $30 billion deal with Meta, right? Like, and it's sort of technically a private credit transaction, right? That spectrum is very, very large, right?
So why is that relevant?
Yeah, so what I'm saying is that, a lot of startups have gone for like, okay, let's build it for the lower end of the market. They're effectively consumers. And then, when you go deeper into credit, you realize that a lot of these lenders really focus on, the subprime market. These are folks that are not creditworthy, and they charge, very high sort of APRs and those types of things. We don't, want to spend too much energy there because it's very risky, to your point. There are lots of lessons of companies that have tried that and have not worked. What's really, counterintuitive is that most people have avoided this sort of middle market space. Right?
Why do you think they avoid it?
It's just hard. Underwriting these businesses is not a cookie cutter sort of formula. It's not like you just look at someone's FICO and you deliver a result.
So you would literally need an analyst at a community. It's usually my job, by the way, as a credit analyst at a community bank.
Right.
And there would be like a propane delivery company that did 100 million in revenue that would have, I forget, it's like a couple term loans with us, a couple million each. line of credit of like 50 million bucks. And it would like literally go up throughout the year and then would like drop to zero in, I'm trying to remember. It was like in the spring or in the summer when like people like delivered the propane, when they delivered all the propane to customers or something like that.
Right. So, that's an ICP customer.
But you probably needed someone like me to go in and like manually figure out if this propane company could actually pay back the loan, and then have like my boss sitting on top of me who was like the relationship manager.
Yeah, no, yeah. So what's funny is that you're just describing the exact type of customer that needs this type of service, right? That customer, by the way, has no other option other than go to a community bank. And the community bank oftentimes is just not the most sophisticated operation, right? They don't really use much technology. That sort of underwriting process would take, months, right? To sort of...
Yeah, I'd probably spend like a good solid 40 hours on that memo to re-underwrite the loan.
Right, exactly. Now, the only reason why we're able to do this is, to be completely transparent, it's because of AI, right? Where a lot of this information, and you'll recognize this from your credit analyst days, is very unstructured. It's not presented in like, a singular database that is standardized for every single company, and every company's financials looks exactly the same as every other company out there.
Yeah, the propane company I do remember had weird, I can't remember. But like the line items you'll see, different companies are all different.
Yeah. So the challenge with middle market private credit is that you actually need to go pretty deep. But how do you do that at scale, right? And so, at the top, the challenge is literally processing that data that you're getting from these companies, both in terms of structured data via API, looking at their bank transactions going back several years, and looking at their accounting ERPs that they're using already, like a NetSuite or QuickBooks, or their revenue accounts, be it like a Toast or a Shopify or whatever, and pairing that with unstructured data that you're getting from the business owner, right? So this could be stuff like their financials, like P&Ls and balance sheet and tax statements and whatever they have, their AR aging, AP aging, which is like,
get a lot of that.
Who hasn't paid you, and what do you need to pay?
We'd have a GC. They do like, I don't know, high 8 figures, low 9 figures in revenue, just a bunch of projects. They give us like their project pipeline. Like we got 10, 12 projects we're working on. And like, this is it. That's what we're working with.
Right. So what do you do with that type of, unstructured data and sort of a hodgepodge of information? Well, you need to build a system that actually understands this information. And so what we've spent the past 3 years doing is really kind of building kind of an end-to-end sort of engine that actually uses LLMs at every single step of the way to truly understand what's going on under the hood. And then it's sort of normalizing that data. And then we convert that information into our cash models that then spits out a recommendation for then our sort of underwriting team to go and evaluate. So an underwriter is only spending a couple of hours looking at a company, but our systems and sort of the back and forth, our sort of gamified sort of data collection system as, user experiences, is sort of using that to collect as much information as possible from these companies, which is why, we have, really sort of our sort of credit book performs really, really well relative to even like a much larger like credit card business like Amex, right? Because we're working with these fundamentally credit-worthy, cash-flowing, high net worth owned business owners and businesses. And so from that context, a lot of the secret sauce here is sort of the unsexy sort of data wrangling engines that we have built, which frankly is very, very hard. And to be honest with you, I think pre-AI could not have been built. It would take us just hiring an army of credit analysts and trying to do this sort of in a tech-enabled way, which takes, even the best case scenario would take, many, many weeks for you to process that data. With our systems, we're able to do it in days, right? And do it at scale.
Is that why it hasn't worked historically? Is because it just hasn't been possible?
Yeah, it just historically combination of like regulation, companies unwilling to sort of go outside cookie cutter formulas, and sort of just being really difficult to underwrite, these sort of middle market businesses. I mean, even if you think about large banks or even like larger fintechs, you could spend all this energy underwriting, a business doing $1 billion in revenue, or you could spend, underwriting a business doing 20 million in revenue, right? So a lot of larger fintechs would just like focus on the much larger deals,
Because you
which
can
is just
lend
easier.
them more money, which makes you more money, more
Yeah.
efficient. Yeah.
Yeah. And so there's sort of like a kind of like a newfound sort of efficiency that we have today that didn't exist sort of like our why now.
Yeah. It's kind of interesting too. I remember when you told me about the personal banking, I was like, oh, interesting, because you kind of like win their business and then you also get their personal, which it's like when you think of like personal consumer banking, the best customers are probably high net worth individuals that own businesses that generate a lot of cash, and you like acquire them through their business and get them personally. I mean, that's kind of the model that you might have seen from like Morgan Stanley, Merrill Lynch type of Bank of America throughout
exactly.
time.
It's very counterintuitive, and it's really difficult to do a B2B fintech, let alone a B2B fintech and a consumer fintech. And so we've had to do a lot of work to make this work, and then build the kind of underlying credit models and internal tooling to kind of do the servicing and processing of these applications in a timely way. But to your point, we're going from this sort of uni-wedge ecosystem of being a business credit card to a business finance platform to now an end-to-end finance platform for high net worth business owners, right? And so we can acquire them from their business end, we can acquire them from their personal end. You could just start with us just using a personal credit card for your, family life, and then over time attach onto our sort of net new products.
Yeah, it reminds me of, I had a Will Gabrick from Stripe on a couple weeks ago, and he spent a lot of time talking about how, with Stripe, the way it evolved, there's really just payments, and like you probably sign up because you're a developer and you start using it because it's the best way to just like accept payments. But now they have like a billing product that's basically replaces your spreadsheet. They have fraud detection, and some people just use the fraud detection, and they have just a bunch of like, they have stable coins now, and like some people just use it for stable coins, but it's just like a whole suite. And it's kind of the advantage of being multi-product like that, where you can like acquire people from different wedges or different entry points. Because that's like, if you only needed one product, you kind of have to wait for the customer to need that thing, versus they might need one of 10 or 20 or 50 different things that you offer, and you can like acquire one any day of the month.
Yeah, no, exactly. Parker Conrad of Rippling, formerly Zenefits, coined this phrase compound startup.
Yep.
Where if you're a company that's building multiple products around a very specific type of customer, where each incremental product actually makes the platform better.
Yep.
Right? Which has like a lot of value. The underlying data works better with each other, right? Like you're using us for banking and cards and your personal life, and you're giving us credit, like all of this is sort of feeding into the engine so that we can give you a higher credit limit, for example, right? And so the incremental kind of value you get from the product at large gets better as you use more stuff. And then the other kind of business model advantage is that, retention of these customers tend to be much, much higher, where, Flex has, in sort of the history of Flex, this is sort of probably too much information, but in our middle market kind of ICP, we've only had 3 customers ever churn for software reasons. And all 3 of those customers were missing integrations that since then we have plugged, right? So the sort of retention of these customers tend to be really, really high, and they stay with you for a lifetime.
Yeah, and you guys are doing, did you announce any public numbers on how you're doing in the press release? What's like the current state of the business?
So we launched Flex in July of 2023. And so in that time, we've gone from 0 in TPV, a total payments volume, analyzed, to now we're doing about $3 billion. And so that business has grown considerably. And we are nearing 100 million in analyzed revenue run rate. We think we'll cross that in early Q1. And so the business is, growing something like 15% month over month right now, quadrupling year over year at scale. And that's sort of thanks to like our kind of multi-product engine where, our average customer is using multiple products from us.
I know. So you mentioned you launched in, I think you said June or July of 23. What was 23 like? I mean, we're talking January of 2023.
Yeah.
Well, I mean, tell me about what that year was like for you.
Flex launched in July of 2023. We had, like a beta product with a few of our friends doing, a little bit of ARR in late 2022, early 2023, prior to our Series A. It was, an interesting sort of journey. I mean, startups is really sort of, really like a lesson in, how much pain you can withstand, right? Like the amount of resilience and persistence it takes to sort of get it to the point where it is today. It was, is sort of crazy just kind of look back at it, right? Our internal sort of value is, it's sort of like a very counterintuitive one. One of our values is bulldoze, which, you kind of have to bulldoze through any blocker that comes up. And so, in early 2023, the bear market just started, right? So you had like 2021, 2022 sort of crazy bull market. We know companies in our space that were doing half our revenue and raised at like $4 billion in, valuation and those types of sort of crazy things that happened in the ZERP era. And then, ZERP, goes away and interest rates go up and the bear market starts and fintech funding completely dries up. And our business requires debt facilities. The debt investors also dry up.
Yeah, 23 was the worst because 22, there was like, people were still alive. And then people started dying in 23 because everyone started running out of money.
Yeah, it was a crazy time, like looking back at it. It was only like 2.5 years ago. So it's like not that long ago.
Not that long. Even ZERP was like, the peak was 4 years ago.
Yeah, that crazy. Like,
we are literally is November, December 25. We're literally 4 years back. With the top.
And so just like kind of like looking back at that period, right? It's like, we raised a seed round, right? And, we had spent a lot of time building this engine and sort of figuring out like what, customer to go after and kind of what band of revenue we want to focus on and the credit models and, specifically on that first product, which was the business credit card that gives you 60 days on every transaction. And then, the bear market starts and, no Series A firm, wants to sort of invest in fintech. A lot of our fintech peers were getting, significantly revalued with massive valuation haircuts and those types of things.
Public comps were down 80 or 90%, depending on the company sometimes.
Yeah. And there was just a lot of like misunderstanding. Like if you look at like Affirm and Klarna and those types of companies, like they're doing pretty well now in the public markets, right? And yet like you go back to sort of like 2023, 2024, some people thought that, these companies would go bankrupt based on like the headlines that, CNBC and others were sort of publishing.
Yeah.
And so, in that period of time, it just took like a lot of resilience because we knew that this customer exists. We knew that our customer is extremely valuable. And we knew that if our customer adopts multiple products with us, they'll stay with us for a long, long time. And so it just took a lot of wrangling of like, putting together a Series A and putting together that first debt facility. And to be completely honest, there's a high degree of probability we wouldn't have made it beyond that point. But
you're saying if you weren't able to pull that off?
Yeah, if we weren't able to pull off, thanks to our friends who came in the sort of Series A and sort of, Saxon Florida funders sort of led that round alongside a couple of our, couple of investors like Newlands, which is, Jan Koom's venture fund and, Companion and a few others. When they came on board, we basically were able to put together enough equity capital that's needed to go close these debt facilities. And since then, we haven't looked back. I mean, we've gone from near zero in transaction volume in July of 2023 to now we're doing billions of dollars, 4xing year over year, right? And so I think from that standpoint, it just goes to show that this game is about surviving. And if you can survive long enough, good things will happen.
So one thing you just mentioned was you kind of like put together the Series A. Like, was it hard? I guess, of course, it was hard. You just alluded to it. But like, how did you kind of pull it off because it was in like the pretty much depths of the fintech bear market?
To be honest, like a lot of venture is who you know, right? In that context, hearing from my friends who were having difficulty fundraising, running fintech businesses, I actually made the decision at the time, which, at the time was pretty controversial. I actually skipped going to a lot of the bigger VC firms. and went to, people who knew me really well. And
so this was Florida funders.
Yeah. So specifically Saxon there, who I knew well from just a bunch of different contexts. I called him up and said, hey, like, we're building this company and we have some pretty good sort of beta traction. And, there's a pretty like formulaic model here where, people want this and, we need sort of the right equity debt sort of stack to make this happen. And he sort of took a leap of faith. And and that was sort of like, sort of the depth of, the bear market trough, if you will. And since then, like, I think, that round was done at like, I want to say like 40 million pre-money or something like that. Right.
Yep.
And, company has grown considerably since.
Yeah. Yeah. I think I invested in
I
invested in a couple. I think I invested 3 different times.
Yeah.
In 3 different rounds. I have 3 line items on my spreadsheet. So hopefully this works out for me.
Yeah.
I'm pretty deep in Flex at this point. I know it was pretty significant to kind of land like kind of like your first big customer. Did you have like quote unquote small customers initially, or like how did that kind of like evolve over time?
Yeah, no, it's an interesting story. So when we first launched, and this is akin to like any startup launching their product, right? So you go out and you have a bunch of like small customers who are mostly your friends, right? You're calling whoever you know in your phone book and saying, hey, try this thing. And so we had a couple dozen, small customers that were just kind of like doing a favor, right? And we started seeing, early sort of traction where some of these friends were then referring us. And so we realized referral channels was a huge sort of channel of growth for us at the time, referring us to other customers. And, we got this sort of random, very large customer in the logistics industry that does, 150 million in revenue at the time. And since then they've grown as well.
And they were referred in?
And they were referred in, and sort of like, that particular customer sort of came on board and we didn't know them. We actually did not know anything about their industry. Like they were in a pretty niche part of logistics. And they came on board and they basically helped us sort of build kind of the early version of our expense management product where they wanted us to, sort of use our sort of net 60 credit card in tandem with expense management for buying a lot of supplies that they need wholesale. And sort of they have this business that's pretty interesting where they buy stuff wholesale and then they sell it retail, right? To a bunch of smaller retailers. So not everyone has the ability to buy products in large quantities for very, very large sort of Fortune 500 businesses, like think, your sort of large electronics manufacturers and those types of things.
So they're kind of like a middle level wholesaler kind of serving a lot of smaller retailers.
Exactly. And so they wanted, working capital to further expand their business, but they also really needed expense management. And so they sort of became kind of sort of a marquee sort of client. And since then they've grown considerably with us. But they then introduced us to 10 of their friends, right? And then something like 6 of their friends became customers of ours. And they're all very large. And they all happen to be, on this one street in Houston.
Okay.
Right.
And that was actually where you guys first launched, right?
Yeah.
In Houston, I remember.
Yes, exactly. We actually, this was, it's embarrassing looking back at it. We had this like, our initial brand was, really terrible. It's like orange color and like,
we didn't think it was that bad.
Yeah.
Maybe it was good for construction.
Yeah, it was like, well, it's just, I guess like I'm pretty self-critical, but it was sort of like, for construction companies, and we were like, okay, Home Depot is a construction business. They're, let's like have like a variation of that color.
It was like a darker orange than Home Depot, right? Like slightly darker.
Right. And so they came on board and they started referring us to other customers. And that was also our first big non-construction customer, right? Because we had a bunch of like smaller construction businesses using us at that time. And so that sort of really paved the way for us to sort of think bigger beyond the construction industry. And we also realized from that sort of interaction is if you do well by one of these sort of middle market companies, they will bring, 5 to 10 of their sort of friends on board, either directly via in-product sort of distribution. They send an invoice to a customer and or they pay a customer using our bill pay functionality, or they literally tell their friends, word of mouth.
Yeah.
And so, 85% of our, growth happens through organic channels today.
So this is events, word of mouth.
Events, word of mouth, and sort of referral channels.
What's the weirdest part of the customer acquisition strategy? Is it the event?
Yeah, I think the weirdest, probably, well, there are a bunch of weird things, right? The entire sort of thesis around Flex is that we have, someone said, what do you think about product focus? And I said, I don't really give a shit about product focus. What I really, really care about is customer focus. So we have a very, very narrow customer profile we serve, which is this sort of middle market business owner doing, call it 3 to 100 million in revenue, right?
Why is that so significant? Why that band?
Yeah, it just happens to be the band beyond which big banks don't think of you as a small business anymore.
So once you cross 3 million in revenue, they're like, you're a big company.
Yeah, you're outside our credit box, and we need to do real underwriting on you and those types of things.
And it's just not worth it.
Yeah. And then beyond 100 million, bigger banks come back into the picture because it's big enough that they are interested in sort of those types of companies. And there are lots of fintechs building piecemeal sort of workflows for those larger businesses, right? And so we had this sort of thesis that broad sort of products, very narrow ICP, right? And so in order to win these sort of customers, you had to do a lot of weird things, right? So it is pretty weird to build so many products at once. We got a lot of advice from VCs that, hey, you may be building too many things, right? Which is one of the reasons why we're winning today, is actually because we've built, this sort of multi-product ecosystem across multiple sort of entirely different workflows that sort of all work well together, which is leading to our average customer using 4+ products, right? And so the other kind of weird thing we did was we realized that, actually spending a lot of money on digital marketing, which we do, is not the best way to acquire customers, right? Because the CAC, over time just gets worse and worse and worse, right? And so...
Plus, you're probably advertising to not the prime borrowers. Somebody Googles, give me a loan, and you're bidding for that ad space.
Right. There's certainly an adverse selection, right? Now, look, we as a company don't mind saying that we're not for everybody, right?
You turn a lot of people down?
We turn a lot of people down. Our acceptance rate is 3%.
Oh, still, I remember it was 3% a year ago.
It stayed pretty consistent. I mean, a lot of people have said, over time, will you just approve a lot more customers? And we've often said no to that, right? We don't want to be a platform that can be used by anybody, because we want to serve the customers who become customers and go through our whole system really, really, really well, almost like a private bank, right? And so that kind of thesis has led us to this sort of customer acquisition strategy that is very sort of community-based. And so we've set up sort of, localized, we call it city managers, where we literally hire city managers in Middle America to go and acquire, the seed network of customers in that city. And then those customers then refer net new customers to us.
So is that person an account rep? Are they a lender? Is an events organizer? What is an ideal person? If I'm a person in Phoenix or Denver, who would the ideal person kind of look like?
We're hiring a bunch of city managers right now. Some are more on, earlier part of their career, where they're really good at community sort of management, and, they have sort of a community-oriented job where they're hosting events and they're sort of a pillar of their community, right? Then we have other folks that, are really well known as folks who can solve problems for business owners. And, we bring them on and sort of give them the resources to really sort of expand that community outreach that they already have, and sort of build a much larger kind of ecosystem of customers that they could work with, right? And so, we have a spectrum of people from all the way from younger folks in tech working community jobs, all the way to bankers, from larger sort of regional banks joining us.
What seems to be the best fit at those roles? Like, is it somebody who enjoys talking to people, that enjoys problem solving? Like, who seems to be best fit for those?
The it's become really popular now, right? The adage around, the phrase around founder mode, right? We need every single person at Flex to have founder mode sort of abilities, right?
What does that mean?
And so what that means is, the ability to sort of see a problem and figure out a solution with absolutely no support whatsoever is a very kind of unique skill set.
That could sound miserable to some people,
right?
Trying to do that.
Right. And it sounds very exciting to people who want to start companies.
Yeah.
Actually, we tell people all the time that, hey, like, if you want to start a company, come to Flex for a couple of years, do a bunch of founder mode projects, and then go start another company. Right. And so that happens all the time. And so, our thought process is that, we want these sort of, self-starters who can kind of own the mission end to end. I think the founder of Revolut said this phrase, which I really liked, the best people are the types of people that are self-guided mizels.
What's a mizel?
Like a self-guided missile.
Oh, missile. Okay.
Yeah. Did I say that wrong?
You said missile.
Yeah.
Missile.
Yeah, I think that's the Indian way of saying missile, right?
Oh, fair. Did you grow up speaking English? When did you first learn English?
No, I went to an English medium school, but my parents speak Hindi, so my mother tongue is Hindi, right?
Fair.
I moved to the U.S. when I was 18.
You kind of have like, you kind of have like a little bit of a maybe British accent?
Yeah. It's like a Dubai accent. You go to people in Dubai, folks there have like this like international accent because they went to like an international school, right?
So fair.
Yeah.
Like you kind of sounds like I have a couple like friends that are like British Indian. You have like a slight flavor of that, but not quite. I guess to the point it's like the Dubai accent.
Yeah.
Which I guess I don't know too many people that grew up in Dubai.
Yeah. It's you'll find people from like Dubai, Hong Kong, Singapore, places like that have like this like amalgamation of accents, right?
Yeah.
So yeah.
Like Hong Kong kind of throws me off a bit sometimes because it's like kind of Australian, it's kind of British, but they also have like a little bit of a Chinese accent sometimes because usually I grew up speaking Mandarin or Chinese.
Yeah, so. makes sense. Like Dubai has a lot of Filipinos.
Oh, I actually didn't know that. Yeah.
Yeah. It's got a lot of Indians and then a lot of Filipinos. And then it's, got like a lot of Europeans. And so you blend these things together, it kind of becomes a pretty unusual accent.
I actually saw this one. This is a complete sidebar, but I'm going to try to find this video and stick it in the show notes for people. I saw this one. There's this guy on TikTok who he finds people's accents and it's all Americans. So it's like an American like one of the videos was like a woman who, I think she was like from somewhere in Florida, was like eastern, west side of the state, middle of the state, Florida, like Sarasota maybe. He painted down her accent, but she like talks and she's just like, where do you think my accent is from? And this guy, it's one of those like investigative, like 3-minute videos where he like did a bunch of like analysis and like pieced together. And he literally pinpointed 2 places. He's like, I think you're in northeastern North Carolina because of this or this part of Florida. And she responded and he's like, she's like, that's it. I was like, holy shit, that's insane. Even in the US, we have such different accents.
Wow, that's like, crazy.
I'm in Michigan. We're both in Michigan right now. And
I feel like yeah, you can tell. I've started to gather like the American accents, right? You can tell like, if someone's from New York or someone's from like Los Angeles. It's like very, very specific kind of variations. Miami too, like you have the sort of Hispanic kind of Spanish, they call it Spanglish, right?
Yep.
That you mix the two.
So one thing you mentioned, actually, I wanted to hit on, you guys kind of rebranded the company about 6 months ago.
Yeah.
It used to be called Flex Base.
Yeah.
And now it's Flex. What was the decision to kind of rebrand? You changed the colors. You're dark green now. You used to be
Yeah. No, it's a really interesting exercise. So first off, like we had a really hard time figuring out what we should call the company when we first started it, right? We knew we wanted to build something in fintech but the first vertical was construction. And so this is the stupidest thing. The way we came about naming it was, we thought, construction has a base, right? It's sort of a foundation, right? And, what if, this fintech was the flexible base to a construction business, right? That's how we sort of named it Flex Base, right? And I'm not making this up, but, in 2023, when we just closed our Series A and, we were sort of gearing up to sort of do a sort of kind of a rebrand of the colors and those types of things. What was funny was, I was listening to the song Rich Flex from Drake.
Okay. I haven't heard that one.
And I was like, why the heck are we called Flex Base? We should just be called Flex. And what's funny is that it was sort of like a random moment at the time, to be completely transparent, we put very little thought into it. But then, it just stuck, customers like, oh, Flex, we get that, right?
Yeah.
And a lot of customers do think of us as this like flex as in flexible, right?
Yeah.
And that's sort of like, grown over time. So a lot of our products, and in fact, even our user experience where you can, gamify the way you sort of pay back your card and those types of things, like is around this sort of principle around offering flexibility to customers. And then the other thing you asked about colors, we did this sort of, this piece we're pretty methodical about, what the feel of the brand should feel like, right?
Yep.
One of the aspirations we had was this needs to be like a consumer grade experience and should have, a consumer grade sort of brand feel to it. But we didn't want to be a brand that was sort of too kind of mass market, right? We did want to have sort of an affluent feel to it. And so we started like researching a lot of brands that, describe themselves as quiet luxury, right? These are like clothing companies and whatnot that sort of, are going after.
What's an example?
An example of this is, I'll give you a random one. Can't believe I'm talking about this actually. A random example is Wall Street Journal did this article on the most worn shoe billionaires wear on private jets.
Okay.
And it's the Xenia shoe.
Never heard of it.
Yeah. It's
Quiet luxury, I guess.
Yeah. The whole point is it's not super well known. It's very comfortable and looks good. Right? And it has like a sort of a premium feel and kind of aesthetic to it, right?
Yep.
And so a lot of that is being very neutral with your color palette and sort of, your typeface. It sort of gives you an immediate recall that this is sort of an institution I can trust, but still have elements of it that, is modern and sort of, has elements of like speed and, reliability, and it just works, right?
Yep.
And so we actually, I think we're one of the few fintech companies sort of branded in sort of a classic motif.
Yeah, that's a good way to describe it.
Right.
Yeah, it kind of does. Because like when I think of most fintechs, I say, oh, that's a tech company.
Yeah.
Versus with Flex, I think of like, oh, that's like private wealth or like a private bank.
Yeah.
Almost.
Yeah. And that's sort of, and our tagline sort of plays into that as well, where we really believe philosophically that we want to help business owners succeed. So our tagline is Flex Fuels Ambition.
Yep.
Right. And so when you think about that, just from every aspect of the brand, right, the way the brand kind of looks and feels to the way our products work, it's all around, fueling ambition. And part of that, our business owners, going back to how we started this podcast, right? Our business owners, frankly, just don't care about like how amazing your solution is, right? Because they're busy people. They're, building incredible companies. Their expectation is your product should just work. The Steve Jobsian thing, it just works. And so it's really kind of important, for us to sort of think about the brand and the product experiences in that sort of like, how can we build kind of the best customer experience that just works for our customer and they don't need to sort of think twice about it.
So is customer happiness something you guys think about a lot?
A lot. It's our sort of first and foremost kind of value is, making the customer happy. And we're willing to do that, even if that means, working on Thanksgiving and,
Yeah, this podcast is being recorded the night before Thanksgiving.
yeah, exactly. Right. And so, I see on X all the time, working 996. Like, if you're working 996, something's wrong with you. You need to work 7 days a week.
Yeah.
Right. And so
you should be working like 9 to 12, 9, 12, 7 or something like that.
Yeah. Well, at least 997, right? Something like that. Right. And so, our view is that, our customers are really busy people. They're running affluent businesses. They're also not the types of people who necessarily are early adopters, right? Like, they're not the types of people who are like going out of the way to, adopt the first new tech thing that came out, right? And so from that standpoint, like, it's really important that, our sort of customer success teams do an incredible job of making our customers really happy. And so we have this sort of contrarian thing where we slightly overhire account managers at Flex just to provide incredible customer service, right? Our customers, believe it or not, like, you can make the best piece of UI. Like, you could build, agents that like do all your taxes for you. The thing that they will remember is when they needed something, they picked up the phone and called a number, and someone answered in 2 rings. And so we've really optimized our sort of entire servicing team for that sort of rapid response, and really track, time to first response and time to resolution on any issue that pops up. And then over time, building software to completely eliminate that from ever happening again, right? And so combination of these things is really, really important. So, our head of customer experience, Ewan, who runs that team, will tell you that we just sort of spend a lot of time, often at inconvenient times, sort of figuring out how to sort of deal with these customer problems. We've had issues where, customer wants to send like a $10 million wire in the middle of the night to China and like, they need to make that happen. Right. And so, to the extent we've been able to sort of, provide them the rails to do it, we will do it.
Yeah. Ewan is telling me too, who is by the way, my account manager, I'm probably like the smallest customer, and also have a direct texting relationship with the head of customer experience, I think his title is.
Yeah.
He was telling me that you're also like the top salesperson at Flex, which I guess like, he's like, oh, it's really surprising. So why are you still jumping into sales calls all the time? Because don't you have other stuff to do?
Yeah, no, I'm kind of unusual where, I like to be super involved in the weeds of the business, right? And so, every sort of founder has a different way of operating. And kind of my whole thing is that, there's so much data that a customer gives you. Every time I have a customer conversation, it's sort of an opportunity for me to sort of learn what their problems are. And I'm trying to figure out, if there's a pattern amongst customers that we can abstract away with new products, right? Or new features, right? And that's not possible if you're not, really close to the customer. And so in order to be really, really good at product, you need to be really, really good at talking to customers and helping them and sort of retaining them over time, right? And so kind of I view my job as like, talking to customers and building products, right? And so, the only way you can do that is, being a pretty good salesperson over time.
And like a lot of times, like that's what sales ultimately is just like, what's your problem? How can I solve it? Really,
yeah.
At the end of the day, do you guys have any custom tooling that you built on the internal customer getting data point side? Are you using like off the shelf? There's a lot of these customer service AI tools out there.
Yeah, what's crazy is that actually this is one of our more contrarian decisions. We've done a lot of stuff that, sort of like, this is not the best practice. Why are you doing it? I believe, I was saying that if you're ever interviewing someone and they use the phrase best practice, they're probably not a good hire, right? And so we do a lot of stuff at Flex that, often will sort of question, what the sort of norm is. And one of the norms is that, a lot of people will use third-party sort of dashboarding tools and, use sort of no-code solutions to sort of put together like an internal sort of tool to manage customers or things like that, right? Even companies at scale, frankly. And so we were sort of unorthodox, where literally at the seed stage, we built this internal platform we call Alfred.
Oh, I've seen that in the board decks before.
Yeah. And so if you think about Alfred, right, it uses the same UI kit our customer products are. So it looks just as good as our customer-facing products, but it's only for internal operations. And so we do everything from, originating, loans to, sort of approving customers across, multitude of products we have, to servicing them, to sort of, building gamification so that they use, our products further, to building sort of new types of risk controls and sort of monitoring fraud, and even building sort of LLMs to sort of give us context on customer conversations and, transactions customers are doing, and, how we can help them even better, and, identifying opportunities to our salespeople to sell more products to our customers, right? And so kind of all those things is sort of powered by sort of Alfred, which has become sort of an unfair advantage to the companies. So as we scale, our Alfred team basically is sort of responsible for being sort of like the nucleus of the company, where a lot of sort of new products, wouldn't be possible if we didn't have sort of, granular control that a non-engineer could sort of like log in and kind of manipulate, how a customer behaves on the platform. That wouldn't be possible if we didn't have like this robust sort of internal tooling. It's a pretty contrarian decision that was, even internally, non-consensus.
Did you want to do it initially?
Yeah, I actually pushed for it. So some people are like, oh, like, couldn't we just like build like, use something like, and nothing against these companies, but, couldn't we like use like a combination of Salesforce, Airtable, and Retool, right? Incredible, like, Airtable, Retool, incredible Silicon Valley companies. But the problem is that, like, it sort of creates a culture of like, if you want to create this sort of vertically integrated platform for your customers, you need to control every single part of that. Sort of like going to the philosophy of like an Apple, right? Like, an iPhone is just as pretty on the inside, which no one sees, as it's on the outside.
Is it? I didn't know that.
That was the philosophy of Steve Jobs, right?
Oh, interesting. Okay.
Yeah,
I got one right here. We could take it apart.
Yeah, actually, Jobs believed that you shouldn't take it apart. So he actually made it really hard for you to open your MacBook and those types of things. And I think the same kind of philosophy applies to banking. Like, if the internal tooling is not good, when a customer calls in the middle of the night and something's not working and you don't have the right tooling foundationally, it's like actually quite hard to sort of help them solve their problems.
You almost make it more fun to like help them when the products you're using internally is good. Like, I remember when I worked at the bank, the things we used to look things up were not the most elegant products in the world.
Yeah,
I can't remember the names of them because they were like nameless, faceless, like ugly products.
Yeah,
sometimes hard to use. Couldn't like search. Like, for example, I don't think you could search for transaction. Like, I couldn't search Burger King or like whatever. Like, I'd literally have to go through, click page numbers, and you'd maybe have to like copy and paste it into Excel. This is obviously 10 years ago at this point. So maybe no one had that back then. But
one of our principles is we like to ship user experiences that have zero UI, right? Like,
what does that mean?
Basically as little software as possible that's customer facing to do a specific task. So for example, you want to send a wire. Can I send a wire in 3 clicks? Even the verification of that from a control standpoint is sort of seamless and, very simple and, feels like you're doing a Venmo transaction, right? That's not possible if you don't have robust controls that are sort of on the other end of the spectrum, where internally you can monitor these transactions and kind of double click on anything that stands out, right? The other part of the zero UI experience is, unfortunately or fortunately, our customers are the types of folks that may not even want to open, the software because they just want to talk to a human to solve a problem. There's a certain kind of ICP that, is not, biased towards just picking up the app or web app and sort of doing something, right? And in that context, it's I think there's a huge opportunity for us where we're building sort of agents where a customer sort of says something and the agent basically does it using the internal tooling that we've built on their account, right? Which is really, really hard to do if to do the right sort of, API integrations and those types of things would take a long time. But then, you build sort of agentic workflows for the customer support team so that, either a human responding or even like an agent responding could resolve a problem much, much faster.
So it's me saying, hey, I want to send this $10 million wire to China, and there's an AI can swap in, and it's also fully connected to all the internal system because it's all built in a seamless way. So in theory, maybe an AI agent could handle, like the software could actually handle that request, not you want it, 2 a.m., whatever.
Yeah, exactly. I mean, in that context, we would want you to sort of be the one originating that transaction. So we would ask you to sort of log in to confirm your identity. But even in that context, there's a lot of sort of clicks that happen with these types of basic workflows. I'll give you a simple one that comes to mind: changing your address, right? It's actually like, there's a lot that happens. There's a security concern, there's a user experience problem. Why are you changing the address? Are you just changing your business address? Are you changing the card issued to you as a business owner? Do you want every single employee's address to change? Like simple kind of thing like that.
And that'd be a classic. Like if I hacked into your account, first thing I'm doing is changing email and address so you can't get any records.
Exactly. So how do you create user experience that is intuitive, right? It's as few clicks as possible, especially if you're using our customer support or something like that. You're able to do those things without you having to log in and having to figure things out, right? And so, it's sort of like come handy. The internal tooling has come handy in ways that we didn't even expect. And the place that where it truly shines is underwriting, right? Like when you take all that unstructured content and you feed it into this beautiful user experience, the experience is, so robust. It almost looks like an investment bank report on a business, like a kind of a sell side report that you put together, like a memo on a company. Yeah,
I have to do that manually in Word.
Yeah.
Spread the financials in, I forget what the name of the software was. Maybe you'd have to make an Excel spreadsheet one-off for each customer.
Yeah. Now imagine doing those kind of one-off Excels and writing these memos in Word, where like now the software is doing it and there's the fields for like manual input that we've sort of built. It's so good that we realize we actually have a very deep understanding of the business and the business owner. If you have such a deep understanding of the business and business owner, why not tell them those insights so that they can get better? And so early next year, giving something away, we're launching Owner Insights, which will take all of this underwriting kind of intel that we have built and package it in a consumer grade experience that reads like a report that business owners get for free with actionable feedback on elements of their business that need to be improved.
Interesting. So why don't you sell this software? Like, why do you go through this whole headache of acquiring all these customers? Like, you should sell this software to another company that wants to do the same thing.
Yeah, no, I think maybe it's a philosophical thing. Maybe it's like a character flaw. I'm not sure. We think that in order to provide incredible user experiences, you need to control the end-to-end workflow. In order to be the best sort of, financial advisor, you actually need to be a pretty good credit underwriter. In order to be a pretty good credit underwriter, you actually need to do credit as an example, right? So there are also sort of all these kind of interlinked pieces. And our customers really appreciate that focus on vertical integration. Which again is it's really, really hard to build these vertically integrated companies. It's easier to sort of just pick kind of a lane and keep iterating on that lane, right? Versus pick a bunch of lanes and, figure out how to sort of integrate these lanes together and create these kind of seamless experiences that follow the entire life cycle of the customer.
Was there a moment where you felt like you guys finally had product market fit?
Yeah. I think
was there, or are you thinking about it right now?
No, there definitely was. Like, I think we knew, like, even before we launched so we launched in July of 2023. We had beta customers starting 2022, right?
So what does that mean, beta customers versus
just like
customers?
Friends of ours who are using like an early version of our credit card. There's so many problems with that early version.
Oh, what were some of the issues?
Opening the kimono here a little bit. I haven't talked about this in years. It's like, the first card was built on just like, in the fintech space, you have all these fintech infrastructure companies that help you launch products really quickly. And in 2021 and 2022, there was like, a lot of hype about these fintech companies that could help you launch card products and banking products and those types of things.
Yep.
So we launched this first like credit card product on Stripe completely on their rails with like basically no rails built kind of in-house, right?
Mm-hmm.
And they were just like, that sort of experience. No dig on Stripe. They're an awesome company, but it was really just designed for like, a very different use case than, fitting it into this sort of 60-day credit cycle that we wanted to use for.
Mm.
And so, there were occasions where like the card would decline because we did something wrong on our end and so on and so forth. And so that actually meant that we had to, completely scrape using, third-party sort of platforms and actually like have to build like an in-house, like end-to-end stack that, we are the program manager. We control every single element of the transaction, and we work with, bank partners directly. And so that was sort of like a whole kind of journey itself. It was not like an overnight thing. It took a while, right, to go through that transformation. But, product market fit, to answer your earlier question, is not like a data point. It's a feeling.
What was the feeling like for you?
Like, it when you have so much demand that you don't know how to keep up with it, right? It when there's like a sort of like market pull that it doesn't feel like you're rolling a boulder up a mountain, right? In our business, we offer net 60 credit terms, sort of like our wedge product, right? That's how we started. And, since then we've expanded. But that product required credit. Turns out you need to raise credit facilities for that.
What was that like?
And so what's crazy is that we had so much demand that for something like 4 or 5 months, we were not able to onboard net new customers.
Because you were just funding this off the balance sheet, like with equity, right?
We were just using sort of equity balance sheet. And then, the 2023 fintech winter started, and that made things really, really challenging, right? And so we had to effectively pause like net new customers for a while. And still, like, we were growing with existing customers. We were sort of kind of using our balance sheet the best we could, and, sort of paused hiring and those types of things. So it really created like a actual, like almost like financial engineering problem, which was really interesting, right? And so, but what was clear to us was, it felt like, imagine like a restaurant, I don't know, like a bagel shop or something like that.
Yep.
And they're selling like bagel sandwiches. And, I don't know, the New York Times or something like that has written like a positive article on them. And some like famous influencer has posted them. And now there's like, a 10-block line outside that bagel shop, right? And the cook in that, restaurant is like, I can't keep up. I don't have enough ingredients, too many people. I don't have enough staff, right? We use that analogy a lot at Flex. It felt like we were like this hot restaurant that had just a lot of demand, and we just couldn't keep up with that demand. And so I think, going back to sort of fintech companies that don't work out, right? A lot of our sort of learnings came from, companies in 2023 that had to shut down. They were forced to. And the learning there was you also have to sort of manage growth correctly, right? Like, there in this industry, unfortunately, you could do things that are irreversibly wrong, right? Like, there's no way you could come back. So you cannot mess up risk. You cannot mess up legal and compliance. And so we actually had to, to go fast, you have to go slow first. We had to actually slow down for a few quarters to sort of catch up, both in terms of product infrastructure to make sure there was not a super buggy experience. When you swipe your card, it goes through all the time.
Declined, yeah.
Yeah. And I think you were one of the early beta customers. I don't know if you remember this, but we emailed you a couple of times that, hey, sorry about the card declining. We made a mistake on our end, right?
I mean, that definitely did happen sometimes. Yeah.
Yeah. So in the early days, there's a lot of stuff like that, right? So in order to really build a system for scale, once we realized there's a ton of demand, we basically, almost like shut down the door, like kind of like a restaurant shutting down for like a quarter to like rebuild the kitchen and like set up the right kind of processes and infrastructure, and then reopened after the Series A and then just like, hit the gas from there. And we've had, gone from zero to, several billions of dollars in payment volume pretty rapidly since.
And so what is it like raising a credit facility versus raising equity? Like, this is debt versus equity. Can you just like help people understand maybe like if they wanted to figure out how to do that, what's the difference and just like how that works?
So for context, we just closed $60 million, which we just announced today, as our Series B. That brings our total equity financing to date to $105 million. And we've raised 2 credit facilities to date, which would bring our credit funding to $300 million, right? And so, the difference between equity and debt, to answer your question, is equity is all about storytelling. I mean, yes, there's diligence. Yes, like you want to look at numbers and you look at a data room and those types of things. But, raising from venture capitalists is, are you building a big thing? And does this have the possibility to be a, $100 billion company, as an example, right? With credit.
And that's basically what you said to Saxon. You're like, this is working. Like, trust me, we just need some money.
Yeah, no, honestly, like the conversation with Saxon, it's like actually like, it's actually kind of hilarious. The conversation with Saxon was like, look, it's like, I feel like I have a restaurant that has like a lot of demand and I can't keep up with the demand. And, I either shut down the restaurant or like, have the sort of right, capital stack to go and solve that problem. And it was sort of a 2-part problem. The one problem was, having enough equity, because the credit folks are looking at 2 things. They're looking at how much equity the company has, what is the balance sheet of that business.
Yeah.
And they're also looking at, what is the sort of quality of underwriting of that business. So unlike, there are lots of different types of debt. We play in this very specific niche called asset-based finance, where effectively they are funding the underlying receivables that is originating from credit cards and loans and those types of things.
So you're basically, you're almost like a middleman for them.
Yeah.
Or you're like helping them reach all your customers, really, at the end of the day.
They're like raising billions of dollars from LPs. Then they're like giving it to a bunch of fintechs like us and many others in the space that have raised, billions of dollars as well. That they give them the capital to then go originate and find, these smaller sort of, buyers of that debt.
Logistics company.
Yeah, it's like random logistics company doing wholesale in Houston, right?
Yep.
And so the challenge kind of at that point was that, we didn't have the right equity stack, given that there was a VC bear market for fintech companies, and we didn't have much performance history on, our underwriting and risk and compliance and those types of things. And so both of those stories required a lot of leap of faith, right? But we were able to pull it together, right? And then over time you build a book, and then you show to the sort of debt sort of capital markets that you know what you're doing, right? And at that point it becomes sort of a numerical thing where once a week, I think every Thursday, we send out a report with like all our numbers to these debt investors, right? And then you use that to then, go raise even more debt and reduce your cost of capital and enjoy economies of scale and those types of things.
Yeah. Well, you mentioned you've done like a couple of things. Maybe they were a little bit non-consensus. Are there any other things you've done that you think probably not the most consensus thing?
It's hard to sort of answer what is consensus and not consensus, right?
What about you, fintech more broadly?
Yeah,
Is there anything you kind of disagree with, or?
There's so many things. And so first off, like, in order to build a great fintech business, you also need to build a great business, right? And the heart of building a great business is hiring the right people, right? And so there's a lot of learnings. This is my third company. I've been building startups for 12 years, something like that, right? In that period of time, there have been a lot of highs and lows. And the common denominator of, low moments turning into high moments was having the right people around you, right? And so it's really, really important to get the sort of recruiting of a company really, really right. And there's just a lot of effort we put into our sort of hiring in general. And we're the type of company that actually doesn't like to hire, right? We have a very kind of high bar and low acceptance rate, if you will. And every single person at Flex who's full-time goes through a final interview with me, which often annoys many of my colleagues, but it's sort of like, it's almost like a gamification mechanism where you want to almost like create this kind of artificial like barrier to just like hyper growth in headcount, where you want to prevent people from hiring way too many people too quickly, right? And then you also want to sort of ensure that the quality of candidates coming your way is really, really high, right? And so you hear, folks like Sergey Brin, Mark Zuckerberg, et cetera, like interviewing people until there were nearly 1,000 employees, right? That's like a lot of interviews because, in terms of final interviews, maybe 1 in 3 candidates sort of go through, right? And so from that standpoint, I'm saying no a lot. And so, you have to sort of literally interview hundreds and hundreds of people every year in order to sort of get to the point you want to be, right? And so does that slow things down? Absolutely. And that maybe is non-consensus, right? But does that improve the long-term health and quality of the team and, long-term durability and endurance of the culture? Absolutely.
What is the culture at Flex?
If I were to like pick a single word for Flex culture, it is intense with, and if I were like, pick a sentence or it's like, it's the culture of Flex is really, really intense with a strong focus on first principles thinking, because there's so many like distinct problems that we're solving for now. It really requires you to sort of think outside the box and, how can you solve for, these problems by, zooming out and thinking through the first principles. There's a Elon quote that we really like at Flex. Everything is a recommendation unless it's the law of physics.
Okay.
Right. And so from that standpoint, right, like if you think about it, you hear about, hiring practices and best practice for this and that. And, it's sort of like, how do you like actually like question the norms to build stuff that like actually works, right? And so we made a lot of decisions that, frankly, like even in fintech, right? Like, for example, even lending, right? Like a lot of people want to stay away from credit.
Yeah.
There's no first principles reason for that. Like there's demand for this. People have done well, i.e. big banks and incumbents, right? Why can't you do it as well, right? And so building that engine, requires like, a culture that's willing to sort of question, these sort of truths that sort of just percolate and no one questions them.
Speaking about lending specifically, because it's a good point. Like you got that from a lot of investors, right? It's just like we don't invest in lending businesses. Period. It was just like we're not even going to entertain this. So why is that? Like if you were to like dissect why somebody might think it's not a good company or not a good investment.
When you think about, venture capitalists, right? Venture capitalists are looking for, large distribution and, large amounts of revenue just, generated from that large sort of distribution, right? But what has incredible demand that could generate that, incredible amount of distribution? Turns out it is credit. The world works on credit. Like every transaction you do has a credit underpinning to it.
Like if every single transaction was required to be settled right now today, like the world would be illiquid. The world would be bankrupt.
The world would end. And what's crazy is that what most people don't realize is that most credit transactions actually are private credit transactions.
So what does that mean?
So like, let's say that you swipe a credit card. Technically, that's not a public credit transaction, right? That's like a private company dealing with a private individual, deciding privately if that transaction can go through or not.
So it's like if I'm swiping my Flex or Amex, it's like Flex is saying, you're making this purchase at Target, or making this purchase at insert whatever, and you're like saying like Target will pay you.
Exactly.
And then this person will pay us back.
Right. Or even if you're like, let's say like you hire a consulting company and consulting company says, pay me net 30, right? That is technically a credit transaction as well, right? And so credit runs the world, right? But there has been this kind of massive philosophical kind of scar, really built on top of scar tissue from failure, where, a lot of companies have tried to build lending businesses by doing novel and kind of innovative things around credit and failed. One of our kind of philosophical insights was that actually, in order to do credit well, you should not innovate. You should just do stuff that works really, really well already.
So how have you not innovated?
So it's sort of like a paradox, right? Like you're saying like, we're a tech company, and we're also saying that we're not innovating on credit. So what that means is that we're not innovating on credit models, but we are innovating on credit processes. So can you give incredibly great middle market business owners more credit faster, cheaper, more efficiently, more seamlessly, without, fundamentally changing the laws of physics around what is creditworthy and what is not creditworthy, right? And so we really, really focus on, super prime borrowers that have incredible cash flows, that have durable businesses, that have survived recessions and survived dot-com bubbles and those types of things, and still around and will be around in 20 years from now, right? And so when you do business with those types of, companies, the credit risk inherently is much, much lower. And so we're not really innovating on that credit box. What we are innovating on is how do you serve these companies far more efficiently.
I feel like that's like what a lot of people say in any of these like successful financial services companies that have sprung up over the past. I mean, really, if you just look at historically, you're finding new underserved customers, or you're using technology to serve them in like a new or different way. So like even what's the company, Wells Fargo, I think emerged from, I may be getting the story wrong, but they like emerged from the San Francisco fire. Basically, San Francisco burnt down. Nobody wanted to touch it. And I think it was Wells Fargo that just was like, we'll bank these guys. Yeah. And now it's like a big public company, because you start like serving a customer that literally nobody else like wants to touch or is able to serve. From like there's probably so many banks were created when like America was discovered. And there's all these like European legacy institutions, back in 1700, 1800s, like we don't bank American companies. Well, guess what? JP Morgan becomes one of the richest guys in the world, just like serving American businesses. Or you look at like Chime, probably so many cases where, somebody looks at Gen Z and they're just like, who gives a shit about Gen Z? Like, we don't need an app. Nobody's going to use phones. And it's like, turns out everyone uses a phone. And I think, did Chime go public? They went public, right?
Yeah, public.
How big of a company is, I think.
It's in the circa 8 to 10 billion market cap.
8 to 10 billion. Okay. Still pretty big.
I might be wrong about that. Validate that.
Probably, I could actually probably double check right now. So I feel like that's kind of, I feel like one of the things with anything in financial services, you like want to figure out like a customer that's being underserved. What is the ticker of this thing? Chime Financial. There we go. Market cap 7.5, 8 billion.
Yeah.
Market's not
I got that right.
I mean, going down though.
Yeah.
Market's not,
No, I mean, yeah. There's with those types, with consumer fintech, it's quite hard. You got to figure out how to acquire customers, and then you got to figure out how to, retain them long term. But they're an incredible business. They've built a great sort of distribution engine, and a lot of just a very large customer base.
Yeah.
So on this kind of note around, finding white spaces, right, and then tying it back to like lending.
Yeah.
So what's interesting is a lot of fintechs, I think especially in this kind of ZERP era, 2021, 2022, a lot of these fintechs emerged that were, we'll go after the underserved and unbanked segments of the market, right?
So what would examples of those things be?
Underserved would be like, you have a bank account, but, the bank has not really tailor-made products for you, right? Because you're in a niche that they don't quite like serve, as deeply as other niches. For example, if you think about like wealth management, right? If you have, let's say, $500 million of liquidity, there are quite a few solutions focused on that segment. But let's say you have, I don't know, $3 million of liquidity. Actually, you'll be surprised that there's a sort of a population of, these types of individuals that are kind of in this no man's land where they're not rich enough to deserve the highest end sort of wealth management service, but also not, poor enough to have, just like
Robinhood.
Yeah, Robinhood.
You're probably stuck using like Schwab.
Right.
I mean, that's what I think about. It's like a
right?
premium brokerage or something like that.
So that's an example of an underserved customer. But then you have customers who are unbanked, right? So these customers straight up don't have any access to financial services. Right?
Maybe like an immigrant or like
right.
a kid. Maybe.
Right. And so a lot of fintechs, I think, like really went after this sort of underserved and unbanked kind of segments, right? We think the opportunity in the middle market, like this business owner that's high net worth and, already sort of affluent, counterintuitively is in the underserved segment, right? No one's really, really focusing on building for them outside the community and regional banks, right? And so we think that like this underserved segment is kind of counterintuitive because, they serve 40% of a bank and payroll. You would expect like, 40% of a bank and payroll is a large enough market for someone to sort of tap into. But there are structural problems with, regulatory problems. And then there's sort of problems around, efficiency of underwriting these, especially pre-AI, right? And sort of like this sort of like bias that a lot of Silicon Valley founders have that, hey, I'm going to do one product and I'll do that one product really well. Yeah. And so it kind of puts you in this silo and you're not really able to solve the end-to-end problem, problems that require vertical integration and multi-product ecosystems becomes really tough.
What do you think was the most crucial product decision that you guys made?
I think there are two that come to mind. The first was like pre-Series A, when we initially were focused on just payments as a problem, right? Payment in itself is really complicated.
So this is the ARAP type dashboard thing?
Yeah, exactly. Like managing your accounts receivable and accounts payable, especially if it's, a vertical like construction, which has a lot of red tape and a lot of approvals. So we thought we'd build way better workflows to sort of manage these processes. What we learned in that kind of first sort of iteration, that it was not a painkiller enough, right? It was sort of like, it helped a pain point, but it was not like necessarily the largest pain point. And so we realized the biggest problem was cash flow. And so how can we help alleviate cash flow problems? Well, we realized, what if we give you, 60-day credit? And that sort of led us to the business credit card. To this date, the 60-day sort of wedge is our best performing wedge. It's doing really well. And so whenever we run an ad for it, we get thousands and thousands of signups. Like, it's sort of like very efficient kind of product decision. The second kind of major, pivotal product decision for us was last year when we realized in 2024 that our business owner combines business and personal transactions.
So what does that mean? That sounds like committing fraud almost.
No, it's like, so you have to understand, like, if you're in venture, right? Like if you have VC investors, you're technically running like a corporation with other people's money, right? So in that context,
you can't just like take your balance sheet and just like transfer yourself $1 million. That's not legal.
You can't do that, right? And so the sort of the boundary wall is far well defined,
because it's like you just own the company, and if you need money, you just
exactly. Versus if you're like a business owner that like fully owns the business, or if there are two partners and there's an agreement between the two partners, like that dynamic is very different. And so we come across a lot of business owners who will spend $200,000 in the morning on inventory for their business, and then in the afternoon, check themselves into a super nice Four Seasons in Hawaii or something like that, right? On the same sort of day. And so in that context, you need to build a lot of products that is not necessarily creating additional boundary walls around the business and personal life, but actually integrate these things into one place. Example of this is, with the Flex Elite card, which we launched today, you'll be able to use a single card for all your entities and personal life. So,
that would actually be pretty nice. I mean, there's so many times where like, I run a pretty small venture fund. I'm not sitting on a shitload of capital, and like we'll have a couple $1,000 at the personal account. There'll be like insurance goes through, dance class goes through. And my wife's like, hey, can you wire more money into the account? I'm like, oh God, I didn't realize it went that low. It'll be like a Friday, you're going into the weekend. You're like, man, you don't want to overdraft going into the weekend, because then it's like, but I have like 20 grand like sitting there in the other account, or you have like $1 million sitting there, and it's like, it should all just be one.
Yeah, no, it's so infuriating that you're not able to just like mesh these things together. And we hear this as a complaint all the time, right? Like, this use case of like, hey, like I have 20 accounts and one account like went down to zero, and now there's like a negative balance problem.
And you can charge overdraft fees in a lot of banks.
And like, why can't you just like reconcile these things? And the same thing applies to spend, right? Like when you're spending, let's say you and I have dinner right after this conversation, and after the dinner we're like, hey, 50% of the dinner was work related and 50% was personal, right? Well, maybe you could allocate those transactions accordingly. So we build this feature called Flex Allocate, where you can literally via SMS, type the word allocate to us, and automatically it'll sort of show all your entities in your kind of personal account, and you can choose how much you want to put in what, right? And so that simple feature like solves so many expense management problems that sort of these sort of commingled business owners who commingle their personal and business life together have to face, right? Even the venture fund context, right? You have your personal life, you have your management entity, you probably have a GP entity, and then you have an LP entity. There may be transactions that may be relevant to more than one entity, right?
Only the management company and personal, because obviously LP, it's just like that is capital. It is sits in my fund admin in escrow. Like I can't
just imagine like you're doing a legal expense, right? Like, are you putting the legal expense in the management entity, or
I actually do pay it off in the management entity? Some people actually expense that to the LPs. I'm like, I don't know.
Yeah,
I also am the person who will literally pay the lawyers as little as possible. Like I will say, like ChatGPT, give me like, pretend you're like a professional lawyer who charges $1,000 an hour. Tell me exactly what needs to be said, and then I will like send that to the lawyer. Be like, can we add this to the docs? Right. Minimize the cost, and it's still like 20 grand.
Yeah, no, it's fascinating to like insane. Think about these use cases, right?
Yeah.
You just have so many different problems that a business owner that is transacting in the millions of dollars, right? Like has to face, that doesn't have. One of our philosophical points that we make internally all the time is, even if you're an enterprise, you have an incredibly sophisticated finance team. But if you're like this middle market business owner that's sort of in this no man's land, they're not too big to be an enterprise, not too small to be called kind of a small business. In that context, you probably don't have a really large finance team. You may have one or two accountants, right?
You probably have like a controller and then like an accountant or something like that.
Yeah, and oftentimes like they could be one person and their title is kind of ambiguous, like finance or something like that. Yeah, Yeah, we even see like office managers and stuff like that, right? And so imagine like giving them the tool set that like a larger enterprise would have, but just for their finances across both their business and personal life.
Talking about kind of all this like personal banking, you guys actually kind of got into this through you acquired a company.
Yeah.
And you did it around when you raised the Series A too. You can probably explain this a little bit better.
Yeah. No. So the context that we did this kind of, again, non-consensus thing, a year after our Series A, we realized that we want to build a consumer platform in addition to our business platform. We had a couple of challenges, right? The first challenge was, well, in order to build a great consumer fintech product, you need a consumer fintech DNA. And the team was very much designed around a B2B motion, right? And so we noticed kind of through self-awareness, we just like being introspective, realized that we didn't have that consumer DNA per se at the time. And the second problem we noticed was that, when you think about like consumer customer acquisition, it's quite different from a B2B sort of motion where you almost need to sort of build a consumer brand, right? And so we were sort of lacking kind of that element as well a year ago. And so we realized that, we need to go and sort of bring new teammates on board because we're pretty convinced that this sort of personal wedge, in addition to the business net 60 wedge, would work really well together. And
so you thought about hiring some people initially?
We initially thought about hiring some people. But then what happened was, through sort of, I guess, unusual circumstances, right? One of our friends, they were building a consumer fintech business that was backed by Andreessen Horowitz and a few others, had built a pretty good platform and initially going after sort of, the Latin population in the United States, right? But they were sort of at a point where they were noticing in their sort of customer base that a lot of the consumers who were coming on board were really using the product for business purposes. Stuff like payroll, like disbursements of payments of contractors. And so they were starting to build like a B2B platform. And so, we were sort of shooting the shit one day and, came to the sort of idea that, hey, what if we did, an M&A and brought our business platform, which was pretty large in terms of revenue scale, and their sort of consumer platform and sort of merged these things together and created a sort of a finance super app, right? Initially started as a joke, but they actually got pretty excited about this idea, right? And 3 months later, we did a full sort of M&A with them and brought that team on board. And now they not only run our consumer team, but they also run our growth team. And so Luciano and Robbie, they're, great founders themselves. And so they came on board and joined our sort of exec team. And so we realized, in order to build this sort of multi-product ecosystem, we have to sort of lean into this playbook of M&A. Not necessarily to grow organically, but just to add net new capabilities. If you want to sort of, not that, from a first principle standpoint, we could have figured this out ourselves. Would have just taken us a year longer, to sort of figure out who the right people were and like what the right sort of strategy is and so on and so forth. And the companies that have done this really well, I would say like, in the HR space, I would say in the, the compound startup, right, is Rippling for sure. They've done this incredibly well. They have something like 40 founders acting as GMs, right? Deal,
they've done some acquisitions.
They've done a few acquisitions, right? Like they've done, I think, if I remember correctly, they've done like a dozen acquisitions or something like that, right? And so if you think about it, right, fintech is such a broad kind of ecosystem, and across our customer, right, once we acquire these customers, they're so valuable. Why wouldn't you want to solve every single problem from the time revenue enters their life to the time it leaves it as personal spend, right? That journey is like 25 chapters. And in each chapter, there's probably a different fintech solving a piecemeal problem, right? So we kind of thought about this as sort of, okay, what's sort of like the elements that we can kind of bring on. And so we're sort of building up this kind of M&A playbook in addition to our sort of core sort of product team building net new products, and how we can merge these things together to move even faster. So we can achieve things in, a quarter of the time than otherwise would.
Why would somebody sell to Flex just because, like, Fiserv, publicly traded company,
Yep.
Pretty sure they've acquired, like, I mean, I think the meme is that it's just like a conglomerate of 1,000 acquired products. Like, there's companies out there that have like done it quite a bit more than you guys have, like a bigger scale. What's kind of like the value prop that you'd be able to, I don't know, give to somebody who might want to sell?
First off, Maza, the company that we brought on, they had multiple offers from much later stage companies, including public companies. And, they chose to go with us. And it's kind of, two reasons, right? First, would you want to go work at, a large company that has sort of a large company culture and like, it's just another job and you're just sort of going to the beach for like a year while you're sort of earning your earn out and those types of things? That's sort of like, an outcome, and it's a respectable outcome.
You probably don't want those people.
Anyways. Right. Exactly. Right.
No offense. I mean, that's great life, but
if you're a company that's ambitious, in our case, we're very ambitious at Flex, and you want to hire, hire is not the right word. If you want to sort of team with killers, you almost need to sort of recruit net new co-founders, right? And in order to recruit net new co-founders, you need to sort of give them very large missions, right? And that is attractive to a certain type of founder who's excited about, building very large things and, possibly having the resources to do that, right? And so our playbook and how we've done this is, the way we think about this is that we can bring in a team through this sort of M&A playbook, initially offer a beta list of customers their product, over the next, call it 3 to 6 months. But over the course of 6 to 12 months, completely rebuild their platform with our sort of infrastructure and our sort of tooling. So it's a completely unified experience. So down the line, you don't have a situation where you have 1,000 distinct startups sort of like creating 1,000 distinct experiences. And so creating that cohesion is really, really important. But, this allows you to sort of, when you're in the market with a product, you're learning data. Customers tell you what works and what doesn't. And so even with our consumer product, we've had a bunch of consumers, high net worth individuals using us for their family spend. And they have told us like, this is stuff that we need. This is sort of very distinct qualities of like expense management at the family level, right? And so we've had to sort of like learn from those experiences, and now we can sort of do a broader launch.
I think one interesting thing about fintech companies in general is they kind of all look the same under the hood.
What's interesting is that like, the reality is that fintech in itself is a commodity.
Just giving money.
Yeah, like
basically.
Sending a wire is sending a wire. Like it doesn't matter if you send it with a big bank or you send it with, a fintech.
Sexy fintech company.
Right? A card is a card.
Does it get declined or not?
Right. Yeah. It's sort of like, these individual Lego blocks are all commodities, right? So kind of two hot takes on that is, the first is, in order to like create something unique, it is really the sort of combination of these Lego blocks brought together in a cohesive user experience, such that, you're building a better experience for the customer by integrating these things in a much better way. And I think a lot of fintechs get that wrong, where they think that, we're just going to build this one thing really, really well, but we won't do 99 other things, and that'll be a good experience for the customer. Actually, that ends up being a poorer customer experience.
So you think you should actually be building a lot of custom tooling and software?
You should be building a lot of custom tooling, and you should be building a lot more net new products that are adjacent to that core product, because customers want a multi-product kind of experience where everything sort of works together, at least in the SMB. And I think that goes along that is the second kind of hot take there is most fintechs, you'll be surprised. I'd say like 100% of fintechs probably have to solve the same 50% of problems, right? So stuff like KYC, KYB, compliance, regulatory sort of, licensing, and sort of managing customer sort of disputes and those types of things, which are highly sort of regulated, and there's a lot of sort of legal around it. You'll be surprised how much of these processes look similar. Just to give like a wild example, at like, let's say a Chime, which is a publicly traded, consumer fintech with tens of millions of customers who are consumers, and a Ramp that is like a $32 billion like, private market company that, serves enterprises with expense management. They both have to do the same sort of compliance and kind of, adhere to sort of licensing and those types of things. And of course, they have different customers, so they have to solve slightly different problems. But, from a focus standpoint, there's a lot of overlap. And so the thing that's often not said when you talk to fintech VCs is how much, in order to build a great consumer fintech or a B2B fintech, you need to build a great financial services business, right? Which big banks have done for decades, right? And so a lot of this work is like really like not glamorous, unsexy, and somewhat like undifferentiated, right? Like you're doing literally the same thing over and over again.
You're saying each company is just doing the same thing over and over again?
Yeah, because the underlying kind of hood requires you to do similar things that are undifferentiated. I'll give you another example. Like, you swipe a card and let's say that was a fraudulent transaction and you want to report that as a dispute with the networks, i.e. Visa and MasterCard.
Yep.
Right? Well, that process across a bank, a fintech, or a community bank is all the same, right? Some are better at managing the customer service and maybe the user experience of like reporting that dispute, but the back end of that process, from a process standpoint, is very similar. And so it's actually kind of like crazy how much of the work fintechs have to do is unsexy, undifferentiated, like kind of like boring. But the unique insight is that, I think the insight is that like if you lean into that work and you build a culture that is fine with that work and is, to my point earlier, like, innovating on making things efficient and more simple for customers, but not innovating on things that work in terms of legal risk and compliance, I think there's a lot of edge that can be found. And so you'll come across these stories in fintech where, they kind of like underdid the sort of compliance part of their business. And I heard this phrase yesterday where, I was at a fintech lunch and, we were commenting on another fintech's, fast growth. And they were like, oh, you want to grow as fast as, well, you can just fire your head of compliance. Right. And so it's like that type of thing can get really like troubling over time, and, it sort of catches up onto you. And so I think, and that's sort of hard to sort of like from a narrative standpoint, explain that to, future employees, future investors, and so on, that, this sort of like, there's a lot of work to be done. That's just like operating.
One thing I want to ask you about, you mentioned like this is your third company. You've started some other companies. I actually met you from a mutual friend, Eric Bahn, at Hustle Fund.
Yeah.
He said that he first met you in kind of like a group therapy session. What were you doing group therapy for?
Yeah, no, it's funny. Yeah, so I actually recommend it. It's a leadership development thing called Pathwise, where 10 founders, sort of public market CEOs sort of get together and just talk once a month very honestly about their business and challenges they're facing, and not only in their business but also in their personal life. And in the goal of Pathwise is to, over the course of several like monthly classes, if you will, teach you how to become almost like a mini psychologist yourself. And so I actually first learned about it from Michael Arrington, the founder of TechCrunch.
TechCrunch.
Yeah. And so a lot of incredible, like, if you tweeted about it, a lot of incredible founders have gone through it. And so you learn how to not only sort of understand, the kind of basics of psychology and, personality types and those types of things, but you also get to sort of become more self-aware. And the idea is that if you're more self-aware, you understand kind of your own deficiencies in your own personality type, and then perhaps you can manage it a little bit better. So you can be a better CEO, better executive, whatever, better investor. And also, possibly manage your sort of teammates a little bit better so that, the kind of cumulative effectiveness of your organization improves. And so Eric and I, funnily enough, we're in this group therapy sort of session. And Eric, I think, was our first seed investor.
Oh, nice. Amazing. Yeah, I know when he first introduced us, he was like, you got to check this guy out. Actually, when I was looking back, I feel like I've gotten some really great founder introductions from Eric over the years.
Eric is such a nice guy.
So yeah, we need to be investing together more often.
Yeah, Eric is a sort of sleeping giant. Like, he's invested in a lot of incredible founders who are, he's great at sort of finding talent that's under the radar. And, everyone has their edge. I think your edge is that you're building up a media empire that, could be really interesting in the kind of early stage space. And then, Eric's great sort of talent is that he, finding people that, perhaps are not as well discovered.
I think I actually found Eric. He did an AMA on Reddit 8 years ago, something like that. I was trying to get a job in VC and reached out to him. And I think I was sort of already doing this, but he was like, "Oh, you should get really big on Twitter." And I was like, "All right." This was a long time ago, but I was sort of already working on it. Yeah. Well, I want to talk about the Thiel Fellows. So I'm trying to remember when you actually did the Thiel Fellowship.
Yep.
What is that like for people who don't know?
Peter Thiel started the fellowship in 2012, 2011. And his kind of big sort of contrarian thesis was that, you don't really need college. Like, K-12 is sufficient to sort of help you kind of achieve your goals. And, college is a huge scam, right? And so, he and his team select 15 to 20 people every year to go through the Thiel Fellowship. And the premise is they give you $100,000, which, after inflation, they've increased it to $200,000.
No, did they? I didn't know that. Okay.
With a single condition that you have to drop out of college. And they literally don't take any equity. It's a grant. And through that sort of program, just for context, over the course of the last, let's say 11 or 12 years, there've been about 300 Thiel Fellows. And from the 300 Thiel Fellows, something like $30 billion companies have emerged. Many very successful companies you've probably heard of, like, Figma, Loom, Ethereum, and a bunch of others. And so, yes, it's probably the best kept secret in Silicon Valley, right? Where, point me another program that has a 10% hit rate to hitting a unicorn valuation, right? And so I went through that, in my class, there were a bunch of like very successful founders there. But honestly, when we first started, we were just like these college dropouts. And it's like an interesting experience. Like, we host an annual reunion in Miami every April. And
is it for every fellow?
Yeah. Yeah. And, about 60% come to it, right? And it's just awesome, like, seeing these folks where, the Thiel Fellow could be, a billionaire, very successful, with, very successful sort of company. And yet, I think the sort of common denominator is that we all dropped out of college and, went straight into building companies and raise venture capital and those types of things.
Yep.
And so it's just been like a really kind of special kind of bond. It's closest thing to like a college frat, but it's not a frat, right? It's like just a bunch of builders who are actually like, opposite of what you would imagine a frat to look like.
Yeah. How do you like get in or apply? What's the process generally like for people who don't know?
Most people apply. Some people get, if you like are famous on Reddit or something, you'll get applied. Rather, you'll be invited. And so most people apply, and you go through this like interview process. And the interview process, it's not like not like a YC, right? Like YC has like, what's your company and those types of things. It's a bit of that. But it's also like, understanding like who you are as a person, because the Thiel Fellowship is betting on you, the individual, versus you, the company. And so
you don't go through with like a company idea.
You do go through a company idea because it's sort of like representative of like how you think and what you think about the world and those types of things. But often there are lots of Thiel Fellows who are successful with their first idea, but often it's usually the second or third idea that is really the slam dunk, right? And so, when you sort of catch them early, if you will, like, you can kind of see them over time and see how they develop. But there are lots of sort of, Figma, for example, I think Dylan has been working on this idea since like he was 18 years old or something like that.
Do you have like a favorite like CEO or business or, company or anything you've like learned from the most over time? And whether this can be like Napoleon, this can be like, IBM, insert whatever. Would you have like any favorites?
Yeah, no, there. I like reading biographies of founders and CEOs in general. And, I'd say like, I've drawn like a lot of lessons from a lot of different leaders. Obviously, like, there's definitely a first principles, like just like learning how to think through first principles that one can learn from like an Elon Musk. But then there's like Jeff Bezos, who runs really sort of complicated, operationally intensive businesses with a lot of elegance, right? And so there's a lot to learn from them. But then there's, I grew up in Dubai, right? And the ruler of Dubai, this probably doesn't come up as often as Elon. The ruler of Dubai, I think, is one of the most underrated CEOs in the world.
Why? So I don't even know who that is.
First of all, the ruler of Dubai calls himself the CEO of Dubai Incorporated.
Okay.
Because he thinks of Dubai as a business. And if you think about Dubai, right, like it's, got incredible tourism, incredible buildings, infrastructure, transportation, the tallest tower in the world.
And energy business.
Energy is in its sister city, Abu Dhabi, but so the country at large has like a lot going on, and they're very active in investing in technology and emerging sort of frontier tech and those types of things, right?
Yep.
And so, one of his sayings that like really has stuck with me as I grew up is, you really need a can-do attitude, right? Like there's literally nothing impossible. So if you think about Dubai, like when my family moved to Dubai, just to set the picture, it was sort of the 90s. And in the 90s, most of Dubai didn't exist, right? It was mostly a desert, right? And now you go there and you drive through the sort of main highway, and you have these like really tall 100-story buildings on either side.
Yeah.
And there are even more cranes building even more buildings. And just like this sort of entire sort of, city that didn't exist 20 years ago. And so, I think growing up, when you think about it from the lens of like psychology, right? Like that does something to you where you just sort of like, if you will it, you can do it, right? You will it to existence, right? And so I think that is sort of like really stuck with me. But part of that, kind of drawing this sort of Elon parallel is your life is all about, just overcoming problems, right? Like there's so many things that go wrong. And as a founder, it's just like really difficult on a day-to-day basis to sort of just like constantly overcome challenges. And I think if there's like one kind of learning as a founder, and sort of, when I think about, CEOs and, leaders that I respect a lot, the common denominator is never giving up.
What's the hardest thing you've had to overcome with building Flex?
I think, we talked about this a little bit, but pre-Series A, after a seed and this sort of 2023 bear market, it was really, really hard to sort of get it off the ground. But there have been hard moments since. Like, it's really difficult, even sort of our kind of risk engine, it performs extremely well today. To build this engine, we had to learn a lot and, sort of like throw a lot of darts at the wall. And, just as an example, to bring on a chief risk officer who thinks like a, sort of a startup founder mode kind of person and brings sort of the best of like the knowledge from the big banks. We had to go through over 100 interviews for the chief risk officer role. Right. And that's from like hundreds of like, people that we screened. And so that type of thing, like just has required like a lot of, painful lessons, but they're not necessarily like, existentially challenging. Like you're not dying per se, but they're still very, very difficult.
Yeah.
And that, continues to compound.
It's an interesting problem where somebody who does risk management, it's like the opposite of startup hypergrowth. Like risk management is like removing risk versus startup is like attacking risk.
Yeah. It's a very, very challenging problem. And, to be honest, it's actually a very intellectually stimulating problem. Like if you're willing to like dive deep into the numbers and understand the fundamentals of these businesses and the underlying individuals running the businesses, it's a very interesting math problem. And so if you're a math person, like, we interview a lot of quants. And I say, if you're a math person, you really enjoy Flex. There's so much math to do.
I mean, what's the math? Isn't it just like a automated pipeline, just spit out some numbers? Like what's the math that goes into all this?
The math is like just, building the models and A/B testing the models on a monthly, quarterly basis to see what works and what doesn't.
What kind of tweaks have you guys been making, like changes? Like, I guess I would have thought they were just like set and done.
Yeah, no, what's interesting is like, one thing I learned, building these things is that the way to think about it is you have to think about use cases and buckets, right? So like I'll give you like 3 separate buckets that are creditworthy individuals and businesses, but entirely different underwriting, right?
Okay.
So one bucket might be you have a business that has, it's selling like, like plumbing supplies and has like 70% gross margin and it grows, 20% year over year and has $5 million in the bank and the underlying individual has a FICO of 800, right? That's one case. Another case might be you have a business that has 5% gross margin, but does 200 million in revenue and, has extremely fast revenue growth, right? It sounds like a AI company.
What kind of company is this?
Yeah. Third might be company has absolutely no profit, right? But has incredible demand and revenue growth and has not raised outside capital, right?
So what might be an example of that kind of company?
Not to go into specific customer names, but, that we come across, these bootstrap founders that, built like, I don't know, let's use a generic one, like an ice cream brand. And they like secured a massive deal with like Whole Foods and they never raised any outside capital whatsoever. And they reinvest every single dollar that comes to the business. So they run their business with like a zero cash balance effectively, or as zero as it possibly could be.
Yep.
Right. But they're doing well. Like, they have a deal with Whole Foods and people, seem to be buying their products. And, you
probably could raise outside capital for something like this.
Yeah.
But I feel like you change the risk profile of the business by doing that. Like you see so many of these kind of bootstrap brands that were no longer bootstrapped and then got fucked.
Yeah. You see the, so that's certainly the case. But then there's some people that just don't want outside capital. And so we see a lot of that.
Yeah.
I'd say like 90% of our customers are profitable companies, right? So we have a very different kind of appetite. And so you have to build models that are specific to each use case and each kind of flavor of that use case, right? And you have to sort of build kind of mathematical kind of formulas rather than kind of storytelling formulas that is qualitative to sort of figure out, a binary decision, do we work with this company or not? And, at what capacity do we work with them? It is actually a really interesting problem. And sometimes we get it wrong, but, luckily not too often. But you do it in such a way that it's within the thresholds that are acceptable, right? And so it's like a constant, like iterative sort of modeling problem. And then, the problem of like, efficiently collecting all this data is also like really, really challenging, right? And so there again, we have had to build a lot of sort of internal sort of AI models that we have fine-tuned over time that we're constantly sort of iterating on to figure out how can we, normalize the content that we're collecting from our customers, across, third-party APIs, across data that they send us in an unstructured form, and also through ongoing use of Flex products. The combination of these things is quite challenging, right? And so, yeah.
Interesting. Is there anything else you want to try to hit on?
I think you've been very confident. This is probably the most comprehensive, not only podcast, but like, VC conversation I've had. I guess like last, just to throw this out there. And how do you edit this? Like, is it like one conversation or do you like?
Oh yeah, it's one. So it's one conversation. I might even leave this part in, this specific part, like this like 30-second exchange. I cut a lot of clips up and throw them up on social. So like something more interesting, like 2-minute segment, going to post like 10 of those on LinkedIn, Twitter, etc. Yeah, the full length podcast, I'm trying to think of how long have we been recording for. People are just going to hear most of it. Like I don't really cut a whole lot.
Yeah. Yep. I guess we didn't talk about AI.
But we talked about AI a little bit. Just woven throughout.
Yeah.
Is there anything else you think people would want to learn about, just generally, things that you've learned about AI?
Yeah, no, I think our vision to become AI native it's sort of like kind of a 3-part vision. So first is we want to automate all the internal tooling that, especially around underwriting and customer servicing. And there's a lot of work to do that because, in order to do that, you need to sort of really understand the kind of knowledge that's coming from our customers. But then the second part of that is if you have a very good understanding of the customer, then can you like help them become better business owners? And I think that's a very kind of interesting problem space where could you be almost like an AI CFO? And if you are the AI CFO, then why go, and that's the third part, why go to sort of third-party tools to do your accounting and tax and financial planning and budgeting and those types of things? And so could you almost sort of generate scenarios where you tell the business owner that, hey, in this scenario, this is what's going to happen to you. And this is, by the way, your P&L, and this is what your balance sheet. And here are a couple of different versions of that, in terms of books. And here's sort of like your tax done for you. January 1, you wake up and your taxes are already done, right?
Oh, that'd be nice. Save me a lot of time.
Yeah. And all you got to do is just validate, and that future is possible. And it's possible because now the sort of LLM models have gotten pretty good and they're getting much better on stuff like financial data, and, sort of Claude has, pretty good model around financial data, and there are a bunch of others working on it. Like, there's a lot of AI Excel companies coming out and those types of things. But that's one part of the thing. The other part is you need to sort of understand and own that data, right? Because oftentimes this data is sort of sitting in disparate systems, which is very fragmented. And so in order to do something like taxes, like for us to do taxes where like all this information is sitting in one place across your entire life, business and personal, is a pretty exciting opportunity to sort of just kind of consolidate these things and just do it for you.
Yeah, because I think about, I do have accountants that do a lot of this stuff kind of manually. And even then it's like, hey, we figured out, do you want to like contribute $15,000 to like the 401k, SEP this year? It'll like reduce your taxes by $7,000. And there's like all these different scenarios that they send me. And sometimes it's just like, no. but other times I'm like, but what if, could I do like 4,000 instead? Or can I do like 20,000? Like what do I need? Like what's that threshold I can hit this year?
Right.
So it's like somebody who can like automatically kind of do that back to you. It's like asking ChatGPT.
We're building an agent for Flex Allocate, the feature I described earlier, where you can carry a single card and after the fact, allocate that transaction to different entities in your personal life. Imagine the agent was suggesting how to optimize your taxes on that transaction, right? And that could be another kind of use case to sort of make things more efficient for you over time.
Nice. Well, yeah, there's been a lot of fun. How can people follow Flex more closely? I feel like you don't really post much. Like you maybe LinkedIn a little bit.
No, to be honest, I've always been, stealth mode kind of, we're a couple months out from hitting 100 million run rate. And, we've sort of been very kind of under the radar, right?
You're like the opposite of me.
Yeah. And so, well, yeah, you're building a media empire, right? And so no, I think, in order to sort of, find Flex, our website is www.flex.one. And we are Flex Super App on all the socials.
Awesome. We'll throw links in the show notes too for all the stuff we talked about. But yeah, this is a lot of fun. Thanks for doing it.
Awesome. Thank you, Turner. This was really nice.
And I hope you thought it was nice. If you like this conversation, please like, comment, subscribe, and share this with a friend who owns and operates a middle market business doing between 3 and 100 million in annual revenue. If you missed it, make sure to check out last week's episode with Matteo Franceschetti at 8 Sleep, and the weeks before that with Rahul Vora at Superhuman and Will Gabrick at Stripe. If you don't want to miss a future episode, subscribe to my newsletter, The Split, linked in the description to get each episode plus the transcript emailed directly to your inbox every week. Thanks again for listening. See you next time.